Good morning, good afternoon, good evening, everybody, and welcome to day 3 of our Global Blockchain Summit here at EY. I'm really excited about today. It's the FS day, and by background, I'm Amarjit Singh, and I head up blockchain assurance here in EMEA, and I'm also an FS partner, so really looking forward to today. We've got a packed agenda for you, so hopefully you can join us and keep up with us. Very quickly, some housekeeping points. If you have any technical issues with the site, viewing the presentation, responding to any polls, etc., please then use the chat box, which should be in the bottom right-hand corner of the screen, where a member of our brilliant technical team is on hand to assist you. And if you also have any questions for myself or any of our speakers, etc., then please use the Q&A session, Q&A button, on your screen. We would love to hear from you, love to get your questions. So, please do submit them. A quick 2 minutes on CPE and CPE polling. Some of our sessions have CPE credits on them, so you will see the questions flash up. Please do give your answers. Some of our sessions do not have CPD credits, but we're still flashing up the questions because we would like to know what you think. So please, if you can, do answer the polling questions, as it'll be really interesting to find out some of your views on some of the topics that will be flashing on your screen. Last but not least, we are also giving away proof of attendance NFTs. We have an NFT to give away at the end of today's session as well. We'll share the QR code later on, so please stay with us. So without any delay, we're going to get started, and I'm going to hand over very shortly to our first speaker. We're going to be talking about staying compliant in a regulated world. We've got a brilliant set of speakers that you will see on the slide in front of you. And our first speaker for today is William Lovell. I met William last week as well at another event. William is the head of technology strategy and architecture at the Bank of England. He leads the technology strategy for the bank. He ensures that projects and programs are delivered to the right platforms and technology. He has a particular interest in fintech, digital currencies, and digital assets. And last week, he told me that he's very keen to ensure that he continues to help educate the public about what the bank is doing and what is coming down the line. So without further ado, William, over to you, sir.
Thank you very much, and thank you for that very kind introduction. Good afternoon or good morning, because I know we have people from all over the world. Yeah, so my name's Will Lovell, and I'm going to talk for a few minutes about CBDCs, central bank digital currencies, stablecoins, and improved payment rails. And the question is, will they coexist? When I saw this title come up as one of the options, I thought this was a great way to actually frame that question and to think about those things. There's a very short answer to that question is yes, they will coexist. So that's a bit of a spoiler for what I'm going to talk about. But actually, what I want to talk about is why that is. So let's find out why. So really, the structure of this is I'm going to talk very quickly about what the Bank of England does, so you can understand how I'm talking about and how we're thinking about CBDCs and stablecoins and payment rails from a sort of central bank perspective, how we're approaching it. I'm going to touch on why payment systems are so important. I think a lot of the time people focus on efficiencies and functionality in payment systems, but don't step back and think about what their wider role in the economy is. I'm going to touch on that, talk a little bit about how the world is changing, because it's changing very rapidly. And then we'll get into CBDCs and stablecoins and payment rails, how they are actually different and where the innovation is coming in those different places. And then last of all, of course, bring it back to where we started and see where they will coexist. So what does the Bank of England do? This is our mission statement. It's to promote the good of the people of the United Kingdom through monetary stability and financial stability. So we are a public body and we're working for the public good. That's the first thing to understand. But how do we do that? Well, we set interest rates, as we have been doing today. We set financial stability policy, and we also regulate banks. But we also do operational things too. We print banknotes for the UK, and we operate payment infrastructure, the RTGS. And the really key component to that is central bank money. So the interest rates that are set by the Bank of England are paid on reserves of central bank money. But we also use central bank money for settlement between banks. It's the way that we take risk out of the banking system. So banks don't find themselves exposed to each other's risks in some very complicated network. We use central bank money for that. So actually the issuance of money and the way that money moves in the system is really important from a stability perspective, as well as a usability and functional perspective. But to meet those objectives of financial stability and monetary stability, we have to have money that is accessible, money that people can use. There's no point me sitting here and talking about the wonderful properties of central bank money if it's actually something that the private sector has found a difficult way to operate in. So there's an interesting tension here about how we devise something that meets those policy objectives, but is also something that people want to use and people can innovate on. And we'll see when we start to get into what the different types of payment system are, how that becomes important. And talking of importance, why are payment systems important? This is a great quote from Biagio Bassoni and Massimo Siracino from the World Bank that I love to throw in. A weak payment system may severely drag on the stability and developmental capacity of an economy. Its failure can result in the inefficient use of financial resources, inequitable risk sharing among agents, and actual losses for participants, the loss of confidence in the financial system and the very use of money. So if that doesn't sound slightly apocalyptic, I don't know what does. What this means is although payments are very useful day to day, they're actually really, really important just to keep the world working. So it's about balancing that tension and bringing those things out. We cannot have a weak payment system, because if we do, it will be a drag, it will affect stability, it will cause a loss of confidence in the use of money. So with that in mind, what's happening in the payment system? Well, it's changing a lot. This is a really useful graph. You may not be able to see it in detail, but you can see the big line descending and the big line coming up. So the big line descending is showing the use of physical cash in transactions, that's by volume. And the big line coming up is the use of electronic payments. And actually the smaller lines all aggregate up. I think it's debit cards on the green line coming up, but other electronic payments are coming up as well. But what does this tell us? Well, it tells us that the crossover point was in 2017, where by volume of transactions, electronic payments overtook physical cash, and it started to widen. Bit of a kind of bump there through the pandemic period, but you can see what the long-term trend is. So people are using money very, very differently. So that is both a risk and an opportunity. And I think payment rails, stablecoins and CBDCs are some of the ways that those risks and those opportunities will play out. So let's take a look at those now. Three things here. Payment rails. When you make a payment through a payment rail, so something like a debit card transaction, or in the UK, if you're using something like faster payments, an instant payment system that are now starting to proliferate around the world, what you're really doing is moving liabilities between deposit takers. That's slightly technical language if you're not an accountant, although I know that a few of you are. What we're really doing is taking the money in our bank accounts, which is effectively a liability on the balance sheet of our bank, and moving it, creating a liability on someone else's balance sheet, and then at some point after that, the assets are sort of trued up. So it's very much a payment rail is sort of facilitating the flow of information that's required to move those liabilities around, rather than the transfer of an asset as you might have if you hand a banknote to somebody. A stablecoin is something that's typically exchanged over the internet, but its value is backed by assets. So this is really taking the technology that underpins crypto, but rather than having an algorithm that guarantees its value or tries to create its value, you have some assets that are held somewhere, held in a deposit account, and we'll look at some of the advantages and disadvantages of that in a moment. And then last but definitely not least, because this is a place I spend a lot of my time, a central bank digital currency. So what this is from a technology perspective, something that draws much more on the kind of stablecoin and crypto type technologies that we've seen recently. But it is centrally bank issued and controlled. So it has the same guarantee that a banknote would have behind it. And this is a bit of a plug for the consultation at the moment. Bank of England is consulting on a retail central bank digital currency at the moment. We'll look at a few of the important sections of that. And there's an opportunity for people to feedback on how they think about what we're doing. So anyway, let's just dive into a little bit more of that detail about how these different things work and where the innovation sits. So I've got some animations here. So what you can see, first of all, is that with a payment rail, the liabilities are really moving there between the different banks, going back and forth all day. And then the assets are trued up with the central bank, which is that little thing at the bottom there. At some point, normally it's like once a day, sometimes it's 3 times a day. It can be more frequent, but that's how we take that interbank risk out of the picture. And we have, it's important, different schemes, as we call them, that are aimed at different use cases. So for example, a card rail is quite different from instant payments and is very, very different from some of the more bulk clearing that you might see for settling a payroll or paying for utilities. So we have these different payment systems that are designed and importantly optimized for the different ways that people use them. And sometimes you see them used maybe slightly outside the way that they're optimized. But this is why we have so many different ways of making a payment. And what that tends to mean is that the innovation that we've seen, and there is a lot of innovation, actually happens at the outside, at the edge, if you like, at the place where that interfaces into how customers are accessing those payment rails. So you can build something that is quite a clever wrapper on a card rail, like Apple Pay or Android Pay, any of those kinds of things, or PayPal, all those kinds of things tend to sit around at the periphery, but the underlying rail is the same, and the way that it's working is the same, which is quite interesting when you think about it, because the retail card systems, the actual underlying process, although it's all computerized now, the underlying process is actually still based on, for those of you who remember it, when you used to put the piece of carbon paper and do the back and forward machine, one of those, that actual process is the same. It's been made electronic, it's been pushed out, and we're now innovating on top of it. But it's actually harking back to a sort of paper-based process. So there's an opportunity to think differently. And one of the things that's made us think differently has been some of the cryptocurrencies that come through, where people have really rethought how the technology might be used. And I want to emphasize there, it's about what's certainly inspiring me is about the technology that people have used and how that might help us to think differently. And then what we can see is we have something like Stablecoins, which is like a halfway house, if you like. It uses that crypto technology, but it has a backing of some assets, which I've got in a nice little animation here, that the assets are placed into custody and then tokens are issued onto a blockchain and then can be exchanged around, as you can see in the animation here, or hopefully I hope that's coming through. The actual use cases for this are mostly about on-ramps and off-ramps for people who are buying and selling cryptocurrencies. It's possible that stablecoins could be used to do ordinary, more ordinary transactions, but we're not seeing that yet. That's not to say that it won't happen, but it's to say actually the main use case is at the moment that on-ramp and off-ramp for cryptocurrencies is a way to people to get in and out. And what we've also seen is that although it has the word stable in it, the value of those tokens can change and can move away from the value of the underlying assets. And there are a few different reasons why that happens. Sometimes it's to do with actual changes in the valuation of those assets themselves. Sometimes it's to do with supply and demand and how quickly new tokens can be minted if they're required, or how rapidly they can be burned and turned back into fiat currency. you start to see spreads in value there. That takes us to the third thing, which is central bank digital currency, which is probably where I want to spend the most time. So as I said, in the UK, we are consulting on a retail CBDC right now. And these pictures here, don't worry if you can't read all of the text. These are lifted from our consultation document, which is on our website. I do urge you to take a look. It's over 100 pages, but it's very much intended to be easy to read and easy to find maybe the information that you're interested in. So the main thing that reason that we are looking at a central bank digital currency, haven't made that decision yet, but we're looking at it, is these two things here. It's really, we want to make sure that central bank money is available to people and that they can use it. Remember I said how important it is to have a currency that people can use. Now, with the physical banknotes, we put a lot of effort into making sure people can get those. But if you think about that move away from banknotes and towards electronic payments, how can people get the risk-free central bank money asset? So that's motivation number one, is to make that available to people. And the second one is about promoting innovation and choice. We've realized that actually the opportunity to devise the platform from scratch gives us the opportunity to enable different business models and things like micropayments and so on. As it says here, the payment rails we have sort of moved us into a set of habits around payments, and maybe there's an opportunity to change that, do something different, do something interesting and innovative. There are some other motivations as well about financial inclusion. As more and more things become electronic, as there's less cash in circulation, how do we make sure that everybody has access to a proper payment medium and things like that? So let's look into this a little bit more. Our model, I'm not going to go through every box here, but what I am going to do is highlight a few things that I think about that are important for the model of how we're doing this in the UK. And the first is that it will be a public-private partnership. So the way we're looking to implement this, should we decide to go ahead, is that the central bank here in the Bank of England, we will do the bit that really only we can do, which is the safe settlement, the safe movement of money from one wallet to another. But what we also want to do is drive that innovation for that second reason. So we see the provision of wallets, of end user technology, the app that you might use on your phone to access this, or the smart card that you might use, being very much something that would be benefit from competition and drive through the private sector. So we're very much thinking about how that will be done in a public-private partnership. The next thing is, and I know I always get a lot of questions about this, is about privacy. There are CBDC, central bank digital currency projects elsewhere in the world where a lot of data is being collected. One of the things that we've been really clear on in our consultation is that we do not want to and will not see personal data. We'll collect the data that we need to do, obviously, to make the safe settlement of transaction from one place to another. We need enough data to do that, and we're going to need data to carry out anti-money laundering and counter-fraud type of checks. But that's no different to using something like a debit card today. This isn't a surveillance effort, and we wanted to be really, really clear on that. And it's actually been really, really helpful to have that in black and white in the consultation as well. The next thing, coming back to this interoperability question, we want to have seamless exchange with other forms of money, including cash and bank deposits. So it's got to be really easy for people to get into central bank digital currency, if you like, and get out of it as well. So if you've got some of that, you want to exchange it for something different, that's got to be easy. In the same way that we want to make sure that the right denominations of notes are in the teller machines, if you go and use one of those, we need to make sure that CBDC can move seamlessly around the system. And yeah, we see access is coming through smartphones and smart cards. So like I say, there's lots more detail about how we arrived at those conclusions and how we think about those conclusions, but I wanted to highlight those because I thought those were the most relevant to the question we have today about how these things are going to evolve next to us. So back to that question, will they coexist? Well, first of all, history tells us that the rollout of new payment rails and payment types takes time. So in the UK, contactless actually first rolled out in 2008. And people are always amazed that it was as early as that. It took a long time for adoption to come through. And then when it did, it's now everywhere. And somehow typing in the PIN for your card seems like an enormous overhead in a way that it maybe didn't before. But it took time for that adoption curve to come up. And that adoption is driven by use cases and it's driven by innovation. So certainly in London, when you could use a debit card or a credit card, that contactless, when you could use that to travel on the London Underground, suddenly it caused people to think differently about the card that they had. Suddenly there was a use case that changed their behavior. And we expect and anticipate CBDCs might be the same. It might be quite slow in the first instance, but it will speed up as new products come to market, new business models come about. And the CBDCs and stablecoins do allow for the creation of those new use cases and of those innovations because they provide different ways for people to interface with that electronic money, which again drives those business models and drives those innovations. I was expecting another slide there. Yeah, sorry, got a bit ahead of myself on the clicker. And remember, CBDCs are giving access to risk-free cash in the same way that banknotes do. And it comes back to this stability point, the importance of having risk-free money that people can use in their everyday businesses for their own purchases, to run their businesses, and so on, in the same way that banknotes do. Now, I think I have a poll question that comes up. I don't know if you can tell me how we jump to that.
Well, I'm afraid that because we had some challenges with some of the CPE sessions, I think they're going to come up later on. So I will leave. Do you mind if we move to Q&A, Will? Is that all right, sir?
Absolutely fine by me.
Yeah. So there have been some questions coming in during your presentation, some interesting ones. So a couple of them which I thought if we have a couple of minutes we can cover. The first one, Will, is in one of your earlier slides you talked about CBDCs, stablecoins, and different payment methods. One of the questions that came in was, what is your thinking about the appropriate regulatory measures maybe in place to maybe protect stablecoin holders? So what are your views about some of the potential regulatory measures to protect stablecoin holders, Will?
Well, I think the top line one is same risk, same regulation. Which is a very easy sentence to say, and it's a great principle to have. The implications of it might be a bit broader. But in the same way that with a payment system or a payment rail, when it becomes systemic, it is regulated in a slightly different way. So I'll give you an example. Visa debit in the UK, and actually I think MasterCard as well now, have regulatory oversight from the Bank of England, and also they settle their interbank liabilities through the Bank of England as well, so that they are not exposed to any of the risks of any of the banks. And the reason that we do that is because those things are systemic. The financial system doesn't work properly without them. So you can start to see how if a stable coin were to get to a very large size where a significant proportion or a very important part of the economy depended upon them, we would need to take those sorts of measures. It really depends upon how they're being used and what the risks are.
Thank you, Will. One other question, and it's an amalgamation of a few questions that we received, and they're along the lines of, with regards to programmable stablecoins, there's some concerns from some of the viewers about whether that programmability could be used in certain nefarious methods, if I could use that phrase, but on the flip side also, some of that programmability could be really helpful and really useful. Any thoughts, Will, on the programmability side, be it stablecoins, be it CBDCs, with regards to that balance about how that can be managed?
Yeah. So first of all, I think programmability is one of the most exciting opportunities that we have, both within CBDCs and in stablecoins. I also think it's something that we will have to approach with caution, to make sure that as we roll out each feature, to understand what the implications of it are. Because once we've put something out in the wild, and people are using it, and people will find all sorts of innovative way to use things that that we haven't thought of. And in the same way that with the rollout of contactless, you saw, first of all, it came out with a very low transaction limit on it, so that we could just understand the technology, and then that transaction limit has piece by piece increased as we have understood more about what the use case is and more about what the abuse case is. My prediction, and I will offer it as a prediction, is that we will need to approach programmability in the same way.
That's a great analogy. I like that analogy with the contactless payment step up as well, Will. That's brilliant. There are also a couple of cheeky questions about whether you will hint at us about what's best suited technology for CBDCs, but I think I already know your answer there, as you are consulting on that.
Yeah, we haven't made any decisions yet. There's a technology working paper that accompanies the CBDC consultation, which shows how we're thinking about it and the kinds of design trade-offs and principles that we're thinking about. We haven't made any decisions, so there isn't something that I'm hiding here. But we do intend to use the next couple of years to very much do the experiments to make sure that we can make the right decision in the right place.
Cool. Well, thank you so much for your time, Will. Thank you for that brilliant presentation. To keep on time, I'm afraid I now must go on to the next presenter. So thank you, Will, from the Bank of England. And we're now going to move on to Peter Liu from Vara. Peter Liu is Vara's General Counsel. Peter, we are really pleased to have you on today on Zoom. Peter's mandate is to establish and oversee the legal and regulatory framework established by Vara to achieve its objective of building a competitive virtual assets hub. And this is going to focus on the protection of investors and market participants. So, Peter, over to you, sir.
Yes, thank you, and glad to be here, and thanks for having me. With the audience that I think we have, I propose to spend the next 15 minutes giving everyone a whistle-stop tour of what Vara has done in the past year, where the state of the regulations are, and what we're planning to do in the year ahead, and maybe leave some time for Q&A. I think coverage within the region has been quite good for us, and we're trying to bring the message across to Europe and to other regions as well about how Vara has been set up. We're keen to be a global part of the global economy here and part of the community of crypto firms that are looking for jurisdictions to set themselves up in. So hopefully by the end of the session, everyone on the call will get a good idea of what the regulations look like, the regulatory journey you have to go through to get licensed, and the types of licenses that you're going to get. So we start off from where Vara is. Oh, that text looks pretty small, but I'll talk it through. So Vara was constituted by Law Number 4 as part of Dubai law. It is a Dubai law specific entity and has remit over all of Dubai for virtual assets and virtual asset activities, excluding the DIFC. It is an ambitious project to create a bespoke, standalone, built from scratch regulatory regime. So we didn't borrow of existing regulatory frameworks and decided to build something from scratch, which was quite a challenge, as you can imagine. We started out with some key principles of being technology agnostic and activity focused. And The reason for that was because as we started looking at all the use cases for cryptocurrencies and the various business models of exchanges, broker-dealers, and borrow lending businesses, staking businesses, there was always a risk that we would get too prescriptive, too focused on the present, and build a set of regulations that would not be future-proof or would not stand the test of time or would require constant revisions. So we went with principles of being agnostic to technology and focusing on activity as opposed to product, because product innovation keeps on evolving. And it's a bit of a, even in the 3 months where our regulations have gone live, we have seen products shift and products, nuanced products are being developed. And we're quite happy with the approach so far, because I think the regulations still are able to find a home or a licensing pocket for some of these activities. The goals of Vara are to build a regional hub for virtual assets, as alluded to previously, and there are other goals there which focus on consumer protection and to create a regulatory framework which brings certainty to the industry at large, to know that VASPs that register and are licensed with Vara meet a minimum standard, have standards of corporate governance, have standards of corporate customer disclosures, and also attend to AML and KYC risks. The ultimate goal here is to create a business-friendly environment that is not light touch on regulations. So we hope that with growing recognition of the steps that VASPs have to go through to get licensed, that we will eventually be able to approach some form of interoperability with other regulators around the world that are licensing crypto firms as well. To be clear, to get yourself licensed in Vara, you will need a Dubai entity, which is commercially licensed in one of the free zones in Dubai. And then you go through Vara to get your regulatory activity license. Moving to the next slide. This is the structure of the regulatory framework that we have come up with. And right at the top, you see that there is the roof of the regulations, and that's supported by 4 pillars of compulsory rulebooks: a company rulebook, a compliance rulebook, a technology rulebook, and a market conduct rulebook. So any VASP that seeks to be licensed by Vara will have to comply with all the requirements of these 5 rulebooks, the regulations and the 4 rulebooks. And moving down, depending on the activity of that VASP, we have activity-specific rulebooks. And these are a broker-dealer rulebook, an exchange rulebook, a custody rulebook, one for lending and borrowing, one for management and investment, and one for advisory. There is a rulebook that has yet to be published, which will cover payments and remittances or transfers and settlements, and that is still being discussed with other federal authorities in terms of its scope and remit. I think the thing to focus here is, again, it is not product focused and very activity focused. So the Vara approach doesn't look at eligibility of coins. It doesn't fixate over whether tokens are securities or not securities. And the only coin that we have in our rulebooks, which are a no-go zone, are anonymity enhanced coins. And even then, there isn't, say, a pure blanket ban against certain privacy coins. And we say that if you can trace ownership and if there's traceability that is afforded in the coin or in the technology managing the coin, then it's potentially a coin that is acceptable to be introduced into the Vara framework. And this slide, I apologize that the text is so small. This is usually presented in a boardroom where people can see it. So if you can't see the text, I do apologize to the audience here. This is a deeper dive into what the regulations contain, and hopefully gives the audience a better idea of the type of corporate governance and corporate requirements that a VASP will have to go through before it gets licensed. So at the top end of the regulation, any VASP will have to assess whether it is conducting virtual asset activities, look at the licensing requirements, and it sets out AML requirements, which attend to federal requirements as well as crypto-specific AML requirements like the travel rule. And we've got a set of market offenses as well, which touch on market manipulation. We have also an insider dealing offense in the regulations. And at the end of the regulations, we've got fines and penalties as well to deal with offenses. In the company rulebook, what we have is the company structure, where you need to set up an entity with a board structure, a senior management structure, and specific office holders to look after cybersecurity, to look after anti-money laundering activity, and to look after compliance activity, and also data protection. There are fit and proper requirements for certain office holders, especially the compliance officer and the directors of the company. And there are also prudential requirements, which is something we spent a long time thinking about, given the insolvencies and shenanigans in the industry that happened in 2022, maybe a bit in 2021 as well. So what we have, and I'm sorry I don't have a slide for this, is prudential requirements that don't focus solely on paid up capital. And we've got 4 limbs for prudential requirements. We have paid up capital that range from, say, 100,000 dirhams, which is about $25,000 to 800,000 dirhams. But we also have net liquid asset requirements, which are calculated based on the operational exposure of the VASP. So this is a kind of a way to calibrate the amount of prudential requirements needed based on the risk profile of a VASP. For example, if you are running a lending book, then we'll look at your counterparty risk, the size of your lending book, before deciding what your net liquid asset requirements are for a VASP. Or if you're a payments firm and you're doing large transactions with huge settlement time, where there is a potential of settlement risk or settlement failure, then we would use that data point and calculate operational exposure as well, and require you to hold net liquid assets equal to 1.2 times a portion of that operational exposure, as a way to safeguard some of the risks associated with the business model adopted by a VASP. The third limb is proof of reserves. I think it's a phrase for those who are familiar with this industry that has been bandied about. We require all of us to maintain 1-for-1 reserves to liabilities match. And they have to match on a 1-for-1 basis based on the currency of the liability as well, so that there's no translation risk. And the fourth limb of our prudential requirements focuses on insurance. So VASPs will have to cover themselves for professional indemnity, D&O, and hot wallet commercial crime. It's a challenging area, and the feedback we've gotten so far is that it is quite punitive to find insurance cover for hot wallet commercial crime cover. And it's something we're working heavily on with underwriters, the insurance community, and VASPs themselves to figure out security protocols which will reduce the risk of hot wallet crime, and therefore also reduce the requirement to have full cover of the average balance in a hot wallet for an exchange. And also the challenge here is that different VASPs have different models in keeping a portion of their cash in a hot wallet and a portion in cold wallets. And the variance is quite, it's quite surprising, actually, looking at different exchanges and the amount they keep in hot wallets. A cross-reference, I think it's the Hong Kong regulations requires that firms keep 2% of their assets in hot wallets at max, and 98% in cold wallets. We don't have a prescribed ratio between what you have to keep in your hot and cold wallet, but we're monitoring that situation. And obviously, if the number is too high, then it becomes a supervision issue for us when we start looking at a VASP on their quarterly and annual cycles, when we look at how their operational risks are being managed. Coming back to this slide here, that's the company rulebook. And in the compliance rulebook, we've got travel rule requirements. The third limb there for market conduct, we've got requirements about what you need to disclose in your client agreements and investor classification. As I read across, the line between broad retail customers and qualified retail customers is 500,000 dirhams, which is about $136,000 before you get to be treated as a qualified investor under our regulatory regime. And the last compulsory rulebook is a technology rulebook, which focuses on security protocol and technology requirements. So all in, it is quite a robust set of corporate requirements that you would have to go through before you start looking at the activity rulebooks, which have additional requirements around capital requirements, public disclosures, certain virtual asset standards, and also very specific requirements, say for the broker-dealer rulebook, you've got best execution requirements as well. And what we don't have a rulebook for is proprietary trading, where there is a mandatory registration scheme and also issuance, which covers the whole gamut of issuing cryptocurrency, crypto tokens, crypto coins, all the way up to NFTs and tokenized real estate tokens. We cover that in an issuance rulebook where we will review the white paper and provide an approval, but it is not a regulated activity. The regulated activity comes post-issuance when you are placing and distributing that minted token, and we covered that in our broker-dealer book, in our broker-dealer rulebooks. This gives you, next slide gives a rough timeline and also attends to the top of it, looks at the 4 groups of VASPs that we're working with. Back in 2022, we started a scheme called the MVP scheme. It was an early stage process where firms who were interested in getting through the licensing process would sign up with Vara pre-full set of regulations. And we've given some licenses out where there are restricted licenses where VASP can operate with institutional clients. Most of these participants are eventually going to move into our full licensing scheme. Some of them will stay there for a few months. And we also have under Group B, a whole bunch of legacy firms that were operating in the virtual asset space before the regulations came out. There is a bit of a grandfathering provision that brings people through to full licensing stage. And then we've got new participants, guys who've been waiting on the sidelines. These tend to be large institutional firms, very familiar names. For those that were tracking the Dubai FinTech Summit, you can see some tweets coming out very publicly about interest in registering their businesses in Dubai and in the UAE as well. So these new market participants, we're having active conversations with them. They're looking at the best kind of regulatory path into setting up their businesses here in Dubai under Vara's regulatory regime. And last and certainly not least, we haven't forgotten the smaller innovators. So our regulations are pretty kind of big boy focused in a way. You've got to be a reasonably mature business. You need to understand how to run a business with loads of policies and procedures, with corporate governance requirements. And so it's not every startup, not every fintech firm is able to come up to speed immediately. And so we're looking at creating some form of a sandbox. I hesitate to use the word sandbox because it's it's got certain kind of assumptions around what a sandbox ought to do. So I use that term quite loosely. It is a kind of regulatory framework where we're catering to the smaller innovators who cannot meet all of the corporate requirements that I've just gone through for the past 15 minutes. And the chart below shows a timetable of some of the licensing journeys that each of these 4 groups will have to go through. You can see on the right hand of it, By 30th November, we hope to get quite a number of these people across the line, which means a lot of us in the team will be fairly busy for the next 6 months. And moving on to my last slide here, one of the unique things that we do in Vara is that we are creating a bespoke monitoring tool internally that will look at on-chain activity. For those familiar in this space, there are some familiar names in that chart, but we're creating our own sort of sentinel to look at transaction patterns, to look at transaction monitoring, particularly, deciphering what's happening within the UAE market itself, within wallets that are UAE focused versus global wallets. But this is a bespoke project that we're working on to give us data points that we're interested in so that we can react quickly and in real time in preventing financial crime. So with that, I will end my presentation and see if there are any questions. I don't have any poll questions, I think.
Thank you very much, Peter, for your presentation there, sir. And really interesting to see what Vara is now getting up to and what Dubai is doing. Some really interesting developments there and some cutting edge changes there as well. Some of the questions have come in. Do you mind if we just spend a couple of minutes on some questions?
Yeah, let's just dive right into them. Yeah.
Brilliant. So one of the questions was this difference that we're seeing some countries taking existing rules, and tweaking it a little bit. Or including digital assets in a way, or other countries creating a whole new framework. What's your thinking on that, Peter, and where your thinking is for Vara and the route you all are going down?
Well, we certainly wanted something that was nimble and flexible, and that's part of the reason we didn't want to build on existing regulations. And so far with the proposals that have come through post publication of the regulations, we think that our set of rules are flexible enough the way we've built them, so that you've got some general kind of rough idea of where the 7 activities are, and then there's a lot of maneuverability and flexibility around what we do. And there's no kind of fixation with certain types of products. So even in the area of derivatives, we don't specifically define what a derivative is. If you trade perp futures and it touches on virtual assets, then you become an exchange that deals with virtual assets, and the kind of perp futures, whether it's inverse or non-inverse, or whether it's daily perp, whether there's other features that are specific exchange, because not every perp future is designed in the same way. Those don't really matter, because for us, if you go back to the objective of investor protection and understanding how the VASPs operate, the product itself, as long as the investor disclosures are there, we think that attends to one aspect of our mandate, which is to protect investors and make sure that there is enough disclosure. The other bit of it comes from supervision of the corporate entity itself. And we spent a lot of time looking at corporate structures and how the entities are set up, how they interact with their affiliates. Because again, looking at some of the failures of 2022, some of them have a lot to do with inter-affiliate or inter-group kind of arrangements, which were done behind the scenes and not fully disclosed to investors. So, we're focusing on the risks here rather than on traditional regulatory structures. And we're quite happy so far with how the approach is playing out.
That's really, really helpful to know, Peter. Thank you for that explanation. One other question, which links a little bit to your point about investor protection, which, to be honest, is very close to my heart. My sort of whole purpose for getting involved in this space, from my background of risk and reg and custody, is very much on investor protection. The right firms giving the right protection to their customers. On that point, how does sort of self-custody requirements or self-custody wallets? What do you think about that one, sir?
I gave a talk to an HSBC audience about a month ago, right? And this was a question someone asked me about FTX, and post FTX, everyone's flavor of the month was self-custody, self-custody. And I asked the audience, which was quite a TradFi audience, and I said, look, how many of you have ever lost your credit card, or how many of you have ever sort of forgotten your bank PIN? And you've got always somebody to call, somebody to go to, a bank branch to enter into. And if you are broad retail and are messing about with a MetaMask wallet or a Ledger wallet, and you lose your seed phrase, that's it. And so from a broad retail perspective, I think some form of centralized trust is still key in creating a safe ecosystem for broad adoption of cryptocurrencies, because it's no joke to lose your key and not have any recourse. So account abstraction, which is being developed, it seems promising, but I think still some form of centralized custody, some form of old school safeguarder of assets is key. And one of the rule books we have in our regime is the custody rulebook, and we encourage VASPs to use a third-party custodian. So even though the Binances or OKXs of the world are permitted to come into the Vara regime and self-custody those assets, they get a Prudential requirement break if they use a third-party custodian. So their reg cap requirements drop if they use a third-party custodian. And this is to encourage, again, accountability and also bankruptcy remoteness, and to encourage the safeguarders of certain assets for institutions, for SITs. And when you get down to broad retail, I've got my views on how I don't really kind of think there's a perfect solution for this, but I think that
Cool.
depending on the maturity of the user, you've got to look at maybe some form of centralized trust as well.
Well, thank you so much for your time, Peter. That was great presentation, great insight, and I hope you can stay on and listen into the rest of the sessions as well. But thank you again to yourself. Thank you again to the team at Vara for joining us today.
Yeah, just one last point, if I may. Vara is open for queries, so if anyone on the call wants to find out more, we're available at Vara Connect at vara.ae. Look up our website, and we welcome a lot of industry inquiries. Thank you.
Great. Thank you very much, sir. Well, with that, ladies and gentlemen, we are now going to pivot to a quick Q&A session. I'm going to be joined by a few of my colleagues, and Claire, who's from the EY team, is going to moderate a conversation between myself, Joe, Makani, and Adam. And I'll leave Joe and Adam and Claire to quickly introduce themselves as well.
Good morning, good afternoon, good evening, wherever you're tuning into. Thank you, Jeet. So my name's Claire Edelgren, and I've got the great privilege to be with you today, sitting with 3 EY colleagues, all partners, all extremely knowledgeable and experienced in the space of compliance and the complexities of navigating the different regulatory frameworks. And what's particularly exciting is that you're all covering very different areas. We've got Adam Gerard, you're here from Singapore. We've got Jeet, of course, UK. This is your area. And Joe is here, of course, from Minneapolis. So I'm really looking forward to hearing what you're going to be telling us this afternoon. So if I can start maybe with you, Adam. So we just heard a couple of really great presentations from both William and Peter, right? We covered Bank of England, we covered Dubai. But what are you hearing in APAC? I mean, I'm super interested.
Thanks, Claire. So I think one of the common themes from both William and Peter's presentations just now was really around consumer protection, and Jeet was also referring to that as well. In Asia Pacific, there's been regulations in place in the digital assets industry now for a few years. Different jurisdictions have brought in differing requirements at different times, and what that's meant is that there's been a little bit of catch up and a little bit of learning in the different countries. So if we look to Japan, Japan has had regulations in place around digital asset exchanges for a few years now. And one of the things that they did in Japan was to restrict the number or the types of securities, or to be more precise, the digital assets that are available to be sold to consumers, which we're now seeing kind of reflected in what the Hong Kong regulator is doing as well. So the HKMA has recently released a consultation paper, which is one of the things it's proposing is to allow that those retail digital asset exchange businesses to operate albeit with a restricted set of assets. Moving over to Singapore. Singapore has introduced the Payment Services Act about 3 years ago, and that covers digital asset exchanges along with a few other types of regulated business. And then in October last year, 2 new consultation papers were issued. One of them covers virtual asset service providers, so a little bit similar to what we were hearing from Peter at Vara, albeit with some jurisdictional differences. But the breadth of that coverage is roughly similar. The other interesting one that the Monetary Authority of Singapore raised in October in the consultation paper was actually on stablecoins. And one of the challenges with stablecoins, it really boils down to trust, and whether a purchaser of the stablecoin, can they really trust what that is, and is it actually backed by the asset or the fiat currency that it is purported to do so. So this is what the Singapore proposal is meant to address to some extent. It's going to bring in requirements for periodic attestation, in order to provide that additional layer of credibility. And it will also have various other perimeters set on it, which the idea of which is to increase consumer protection, but also increase consumer confidence, which will then presumably help to increase the take-up of that. Then I look at some of the other APAC markets, Korea and Australia. Korea already has recently introduced some regulations in this space as well. Australia has been talking about it, and there's some initial legislation in Parliament at the moment to bring that in. So that's at a slightly earlier stage. But I think bringing everything together, what we're seeing both in APAC and globally is that we're now seeing many global regulators of a lot of the larger or more advanced economies really starting to get to a rather similar position, albeit via different routes. But the end goal is again around consumer protection, and I think over the next 1 or 2 years we'll see a lot more consistency in the regulated environment.
That's wonderful. That was a lot of countries to cover.
It was, wasn't it?
So yeah, it was like the quick whistle-top tour of Asia. I love that. Jeet, I know you spend a tremendous amount of time with custodians. So tell us a little bit about what you're seeing. Tell us what you're hearing.
So on the positive, I guess, because we have MiCA now for the EU, my sort of area of EMEA is been made a little bit easier, Claire.
Fantastic.
With MiCA on the horizon, and I still don't know whether it's MiCA or MiCA, but I'm going to stick to MiCA. And I think it's really interesting to see the different approaches that are being taken by the various regulators, be it Vara, who we just spoke about from the MENA region, or MiCA, or the UK with the FCA. But I think what it still boils down to me, as somebody who's been in the custody space for a while now, is I think the principles of custody remain the same. Yeah. Right? It's about protection of assets. It's about how you give that comfort and how do you give that protection to whoever might be holding those assets, be it digital assets or traditional assets, or if you go down the tokenization or tokenized world, then that boundary is going to blur anyway, right? So what we've been trying to do and what we've been working with some of the regulators at is it's looking at what are the principles of custody that you should be thinking about, which, surprise, surprise, don't really change from the traditional world to the digital world, right? The risks are the same. The macro risks are the same. How they manifest themselves might be slightly different, right? So, back in the old days when I used to do physical stock counts, You did want to know where the physical key was to the vault, right? And you prayed that they didn't shut the door behind you. Now you've got a private key. You got the digital equivalent, but the same risk is there. How do you know it's not the only key? How do you know somebody hasn't got a copy? So to me, I think the interesting point that I think I would urge the industry is to continue to look at the risks, continue to not throw the baby out with the bathwater, that a lot of the understanding that we have on the risk side is still very much applicable to the new world that we're living in. But it's a personal view on this one. I would caution rules. I would caution rules. The reason why I would caution rules and I would think more about principles is the technology is moving so quickly, right? New different types and better technologies and better approaches are coming up. So, I do get a little bit concerned about hard coding into rules a particular way of doing something, right? And, the law of unintended consequences and all that sort of fun stuff, right? We do need to sort of think about how can we come up with principles, come up with some strong guidance, which give some guardrails, give good advice to the industry in terms of how they can then comply with the principles, and also maybe tool up the regulators so they can get comfortable as well to actually assess the different approaches that firms are taking to be comfortable with what some of this new technology might sort of manifest and bring to the table. Because I don't know about you, but I think this is still very, we're at the baby stage. I think yesterday somebody used the analogy, didn't they, day before yesterday at our kickoff on day one, that if we're not at the 1990s here, we're actually at the 1983 here, where IBM has just released its PC. We're at that stage. We're not even at the 1990 stage yet. So to me, trying to sort of make sure that what we bring into place is fit for purpose, it's flexible enough to allow for the right outcomes, but critical enough or important enough to ensure investor protection and ensure custody protection. I think it's quite key. And I think that's going to be the challenge for be it the EU regulators or the UK regulators or Vara or any of the other regulators that we've spoken about today. And I think there's an opportunity here for firms to actually get in front of that, to set their stall up and say, look, this is what we think is the right thing to do.
I love that. I think so. Stay grounded in what you know, but flexible enough to work with the technology as it evolves. And I think that's a really sound advice. Joe, I've got to say, you're probably in one of the hot spots, right? I mean, it's been a very tumultuous last few months. We heard Caitlin Long on Monday talking about the urgency in the US to have more regulation in place. You're in it. Tell me. I mean, really, what are you advising? What do you do?
Well, I think what we're advising is consistent with the themes that you've heard already, and we'll hear later today. It's proper risk assessment, proper controls, and proper segregation. I mean, those have to be in place for any of our, players in the market right now, because those are the key fundamentals to what we see in the digital asset landscape. The U.S. is really interesting right now, well, in multiple ways, but you've got the political environment that's causing some strife within, how are decisions going to be made now? Could that have an impact on what we're going to see over the next, call it 18 months until the next election cycle comes up, and you could have some major changeover there. You've got different perspectives at the federal and state level, which I think is really unique because you've got these state charter licenses that are out there that are available, but they may not fit within the federal frameworks. And so starting to manage what's going to be a qualified custodian, I think that is the biggest question that needs to be determined for this industry to continue to move forward. Because if you are trying to meet some of the federal definitions of a qualified custodian, recent commentary may indicate the exchanges don't meet that definition. So I think we need to come to clarity on that first. And that has to be the central focal point for any regulatory regime going forward, is what is going to allow the investor confidence to be there in this marketplace to continue to grow. And we have seen our clients and folks that we've talked to in the marketplace pulling back on their U.S. operations because of the uncertainty in the regulatory aspects of it. And without clarity here, it will continue to cause challenge. But once the clarity is established, those folks and those companies that focus on risk assessments, proper controls are going to be best positioned to navigate any of the future regulatory considerations that pop up. So I think that, consistent theme across the board, but that to me is the biggest item.
Yeah, get started on what you know.
Exactly.
Yeah, really, I love that. We have a very short amount of time left, but I do want to do a quick fire back around once more because quick question for each of you, and you'll have the advantage. Oh, well, maybe we'll start with Joey this time. We'll work backwards. We'll give you some thinking time. What matters most?
Protection of customer assets and just having the right proper controls in place. You look at what's happened in the market over the last 18 months, it was a lot of lack of controls and infrastructure. And I think those have to be there for the investor confidence outside of the core community to be there, right? It's the core community, I think, is solid in the foundation, but it's kind of the people that are outside of that really need that understanding.
Yeah.
Legal certainty to build on that investor protection. We need that legal certainty that people then know that if they're trading or they're buying or they're selling with smart contracts, blockchains, etc., that the courts will treat these transactions in a particular way, and they then have that certainty of treatment.
Predictability.
Predictability, exactly.
I like that one. Adam?
I would say, in addition to those two, I would say regulatory consistency. I think there is a danger in a fast-moving industry that there will be differences in the extent or the breadth of the regulated activities, which can then lead to regulatory arbitrage. So I think it's one thing it's a good thing having an improving regulatory landscape at a country level. I think to go to the next level, it needs to be there needs to be that interoperability and interconnectivity between the regulators.
Well, and that's the hardest part about this market, right? Is it operates all over the globe, and there's inconsistent frameworks just about everywhere you go. And coming to a global standard, I think, will be very challenging in the near and long term. But there has to be some consistency across the board, Adam.
Well, I think the good thing is that what we've just heard is that it's definitely moving, though, in all areas. So you're not going to end up with, half the globe, light years ahead and other people not yet started. So it sounds to me that at least the conversation's going on. Everyone might be starting from different perspectives, but at least that's happening. So I've got to say, thank you so much. It's been super insightful. Really good points that have been raised by everybody. And I'm certainly looking forward to the next session. It's going to be future of payments, I believe. So don't go anywhere. Stay right here.
Indeed. Well, thank you very much, my fellow panelists, and thank you, Claire, for taking us through this session. I am now going to invite Munib to come and join me. And Munib Shah is one of the tech senior managers who works with me here at EY. I'm going to hand over to Munib, who's now going to take us through the next session on future of payments. Munib, over to you, sir.
Thank you, Jeet. Good afternoon, everyone. I hope you're having a great time, within this blockchain summit over the last 2 days, today being the third one. I'll be joined on this panel with a very esteemed set of people. So, Chen Zhur from EY, Ran Goldie from Fablox, Peter Left from LBG, and Nabil Manji from FIS. So what we'll unpack as a part of this session today is the future of payments. So with that, let me call our panelists. Peter, Chen, if I can have you on stage, please. All right. So shortly on the way. So while they do that, let me introduce myself. I am responsible for digital assets technology consulting for UK Financial Services. I've been in the digital asset space for a while and have been through that trough and peak of digital assets in terms of seeing it manifest. One of the core use cases that we have seen evolve over a period of time has been payments. And I think that's what we will decipher a little bit more today, dwell a little bit more on today, look at the various use cases that we have underway. So our panelists are getting mic'd up. Bear with us for just under a minute. They should be with us shortly. And while they come on stage, so we have Nabil and Ran already with us. on the call. So why don't I start with the introductions? And Nabil, let's start with you first. If you could kindly briefly introduce yourself, and followed by Ran.
Company is leading what we call our global crypto and Web3 business. So basically managing sales, account management, strategy, marketing, and partnerships for all the products and services that WorldPay provides into the crypto and Web3 ecosystem.
Thanks, Nabil. Ran, a quick introduction from you, please.
Yeah, thank you. And great to be here. I'm sorry I'm not there personally. My name is Ran Goldstein, or Goldie in short, and I manage the payments division in Fireblocks, which is a platform for digital assets. We'll probably dive into that soon. And what I mean by managing payments is it's my role in the company to make sure that if you are a PSP, a payment service provider, or any other company that is handling payments, and you want to do something with digital assets, then you know that Fireblocks is a home for that and your platform for that. And looking forward to talking about what payment use cases are actually working out there, not just fantasizing about how blockchain gets into payments, but showing everyone here in the crowd what's actually working alongside Nabil, and maybe even trying out a live demo, which I'm sure will fail because we're in a live presentation, but we'll give it a try.
Fantastic. No, I'm sure we'll all succeed in this. So why don't we maybe start with your presentation and your demo, and get it started while the other panelists join us in. So if I could request you to please run us through what the future of payments from a Fireblocks and FIS's perspective is with respect to the ever-evolving world of digital currencies, that'll be fantastic.
Yeah, happy to. And I'll be doing this with Nabil. I hope everything obviously will work. So Nabil, if you don't mind, maybe giving a few words on WorldPay quickly.
Sure. Yeah. So for those of you that aren't familiar, WorldPay is one of the 3 business units within a larger financial technology and financial services organization called FIS. Within FIS, we have 3 main business units. Starting from the left, our first business unit is called Banking Solutions. As the name would suggest, this business unit targets banks as their primary customers and provides what I like to call the plumbing of the banking ecosystem or the banking vertical. So our primary products include core banking platforms or ledgers, a lot of business process outsourcing, things like hard issuer processing, and a whole other bunch of bits and pieces that help banks manage their back end. That's a very global business. We operate in pretty much every region. Our second business unit is quite similar, but targeting a different audience. That is called Capital Market Solutions. So again, as the name suggests, that business unit typically targets asset managers such as hedge funds, pension funds, retirement fund administrators, et cetera. Again, very global in nature, and again, providing a lot of the core infrastructure and plumbing for those businesses to run their day-to-day operations. And then the final business unit, which is the one I work in, is called Merchant Solutions, or better known by our brand name, WorldPay. WorldPay is the world's largest merchant acquirer in the world. And for those that aren't in the payments industry, you might hear it referred to as a payment service provider, a PSP, or payment processor. And essentially what we do is we allow businesses around the world, small and large and across verticals, to accept consumer payments using instruments like debit and credit cards, e-wallets like Apple Pay and Google Pay, or a variety of local payment methods, such as open banking or local e-wallets around the world. And in addition to the core payment services, we provide a bunch of value-added services, so things like foreign exchange, fraud and risk management, data analytics, reporting, reconciliation, et cetera. So yeah, fairly large company, but one that most people haven't heard of. In terms of our business as it relates to payments, as you can imagine, working with banks and capital markets and merchants, we are at the core of how money moves around the global economy. Just some fun facts in terms of scale. Last year, we moved about $9 trillion, either physically through our bank accounts or digitally across our platforms. We've got over 20,000 clients around the world, including those that represent over 1 million kind of brick and mortar locations on the merchant side. On the issuer processing side, we do the processing for about 1.3 billion cards that have been issued by banks and credit unions and other financial institutions around the world. And today we are just over 55,000, I believe closer to 60,000 employees, and operate, as I mentioned, pretty much globally. And despite being, what I've described as a large behemoth legacy financial technology and financial services player, we actually are very, very deep into the crypto space, and actually have been since 2015, so coming up on 8 years now. As it relates to crypto, we are the #1 merchant acquirer in the crypto sector. So what that actually means in practice is if you go on any crypto exchange or brokerage or fiat on-ramp and use your debit card or credit card or e-wallet to buy Bitcoin or ETH or stablecoin or whatever it might be, chances are that we are processing that transaction on the back end for the platform that you're using. We've also had a bunch of firsts in the industry. We were the first to launch in the US and Canada for payment processing for crypto, also the first to partner with Apple and Google Pay to enable consumers to use those purchase instruments to buy crypto, and these days process in the neighborhood of between kind of $10 and $20 billion a year, depending on the market conditions, of fiat currency into the crypto ecosystem. So yeah, very familiar with what's going on in the crypto space, and particularly what's going on at the intersection of crypto and payments, given our broader company and where we sit in the industry.
Perfect. Thanks, Nabil. And we'll talk about our joint solution in a second. Just a quick one about Fireblocks. We're first of all, we're not making 15 billion revenue a year as WorldPay FIS. We're just a 5 years old company, but luckily we've become the #1 platform in the blockchain space, crypto space, for any company that really wants to build applications on digital assets, whether if they want to be a custodian for institutions, or if they want to create secure wallets, if they want to enable payment solutions, Web3, tokenization of assets, and so forth. A bit over 1,800 clients, secured over 4 trillion in transactions. And you probably know some of the entities we're serving, like WorldPay or Revolut or eToro, Bank of New York Mellon, Crypto.com, etc. But me specifically, I focus on the payments front, right? So other than the fact that we serve, I would say, a lot of different protocols and blockchains as well, what I want to take you through is how are we looking at payments now? This crowd is very knowledgeable probably about blockchain, and you probably already know this, but blockchain is really a payment system, right? So there's ACH, SEPA, SWIFT, faster payments in the UK, Stay in Mexico. They're all great. They are payment systems. And we look at blockchain as another payment system. And we really think blockchain is that missing link that can connect a lot of local payment system in different jurisdictions, because some of them are getting really fast, really good, but it's still not a global payment system. We think blockchain can unlock this. And we really believe that all businesses will have to adapt and have a leg in this system. So the same way that WorldPay, as Nabil said, they're doing a lot of different things like paying out or accepting payments. They're using a lot of different rails like card rails or, again, ACH or SWIFT. They also understood they need to have a leg in blockchain because a lot of the volume now goes through those type of rails. And they're, looking at the future, really the way we look at it is there's 2 key enablers to how payments will probably evolve and grow on blockchain. The first enabler is tokenization, really, of currencies. And the second one is actually the proliferation of on and off ramps. Now, there's this slide I like to show. Maybe I need to beautify it a little bit, but the more currencies are being tokenized, we have now dollars, obviously, USDC, USDT, so forth. We're slowly seeing more stable coins like the Mexican peso. There's a pound stable coin. Brazil is doing a lot of things, but the more we're going to see more tokenizations of currencies, the more companies are going to feel comfortable, but they also need doors to on-ramp and off-ramp, right? So people only feel as comfortable coming into an ecosystem if they know they can get out of it if they want to at any point in time. And we still don't have a lot of very reliable on and off-ramps around the world. I think that will be a very big enabler. Another thing that's written here is the on-chain effects, right? Like today, if you do payments, you still probably use USDC, USDT, maybe USDP by Paxos. But really, sometimes you want to move between different currencies, and that you still need to do through fiat. What we're thinking will also expedite is if we have an AMM that's doing an on-chain effect, that would be amazing. And obviously, the interoperability is important. That will bring more actors in. And eventually, CBDCs, right? Once we'll see countries coming into this and creating the right frameworks to have private companies or banks issuing currencies, then it will go out to every business. And obviously regulation needs to support all of this. But we really believe every company in the world will essentially be doing blockchain-based payments within the next 5 years. Now, what are these companies in blockchain building on top of Fireblocks or top of other companies? What are they doing? What's use cases? So there's 4 big use cases that we see are right now live, right? The first one is merchant settlement with a stable coin. And this is what we did with Nabil, with WorldPay. We will show this in a second, but we figured out that, okay, WorldPay is serving a lot of those very important exchanges. They want to settle with those exchanges using a stable coin, not just send them fiat through SWIFT. Let's build a use case around that. And I'll show that in a second. Another use case is obviously cross-border transfers, where you want to move fiat to fiat between 2 countries, but you want to move it quickly and you want to have a very regular cadence, not just send money on a Monday, hope it will get there by Wednesday or Thursday, but send money on Monday, Tuesday, Wednesday, Thursday, and make sure it arrives within 15 minutes, right? So that's another use case. We see payments coming into it, and this is already live, by the way, as well. Creator payout is something that's slowly picking up. We see PSPs coming in and saying, hey, we want to pay out to a marketplace creator. Just as an example, let's say Spotify wants to pay out to their creators, right? WorldPay would need to step in and help them do that with crypto as well. And the same way they're helping him to do it and pay worldwide with fiat right now. But it will be much faster, it will be much more predictable, and they could actually even issue wallets if they want, right? And the last one is crypto pay-ins, which we all think that 5 to 10 years from now, we're all probably going to pay with a digital form of money that is a stable coin. Not necessarily means that we're big believers in paying today with Bitcoin. I honestly don't think that's probably the best usage of your Bitcoin, especially with halving coming in a year. Hold on to that Bitcoin. But we really believe that within a few years, a lot of people will be paying with stablecoins, even if they won't even know it through their fintech apps. So let's go for a second to look at what we did with WorldPay, who are a great partner for this. Again, like Nabil said, they already serve a lot of crypto exchanges, so it was very obvious for them, I think, that they want to. Let me show a better slide. They want to get into this world. And what I want to show in this slide is an example with a client called Crypto.com that basically, as an example, they're an exchange. And as Nabil said, if you're a user and you want to get to Crypto.com and you want to pay them $100 and you want to get Bitcoin worth $100, WorldPay would process your card. They would get authorized for that transaction. And they will tell Crypto.com, hey, that user is good for those $100. Crypto.com will send the Bitcoin to the user instantly. WorldPay, in effect, would have to send Crypto.com the funds, right? Now, that would take a day, 2 days, 3 days, depending on, geographies and other sort of, weekends or not. What WorldPay really wanted to do is to pay its merchants 24/7 if they can, or at least as fast as they can, and do that with a stable coin instead of going through fiat. So the new flow is really a user comes in, pays with the card, but once WorldPay gets authorization for that, whenever they want to, even immediately, even if in a few hours, according to certain risk appetite that they have, they can initiate a flow through the Fireblocks payments engine and essentially turn the funds that they wanted to send to crypto.com, to the exchange, to a stable coin, have the Fireblocks platform orchestrate all of that move, help them manage their merchants, and eventually send a USDC or some other form of stable coin or a crypto even to crypto.com. And by that, achieving a settlement that is at least 3 days earlier than what crypto.com would receive, and preventing them from being in some sort of cash flow deficit, if you will. And what I want to do is I want to take you to actually a demo of this, right? So let me switch tabs for a second. This is the Fireblocks platform. I'm going to try to do a live demo. There's a 99% chance this will fail, but I have high hopes. So WorldPay is a sophisticated company. There's not a person sitting in front of a screen and doing this, but they're doing this through APIs, etc. But let's envision for a second that I'll be doing this manually. So what happens behind the scenes is I as WorldPay, I want to manage my merchants. So Nabil, I apologize. I did some demo merchants. I hope you support, I don't know, Binance, Spotify, Netflix, whatever, or your own. So I would manage my merchants here. And let's say I just processed, I don't know, $100, as we said before, on behalf of crypto.com. Automatically an API call would be sent out to Fireblocks. And what would happen behind the scenes is they will say, hi, we're WorldPay. We want to take $100 from one of our accounts and convert that to USDC, and essentially create this instruction list to say, hey, we want to pay out to crypto.com, right? And they want to pay USDC over Polygon, for example, and let's pay $100 and add that to the instruction list. Now, all this would happen through an API, and they will submit that. Let's do that. Let's see if I have $100. I don't know. They will submit that, and it will start flowing between WorldPay accounts to crypto.com. Now, all of this would happen automatically once WorldPay gets an approval of the transactions, or whenever they decide they want to do this. That's just one example. Another example that, as I told you before, another use case is the cross-border transfers, right? So let's say WorldPay wants to move funds from Mexico to the US, right? So they can create this flow where they say, hey, I want to on-ramp Mexican pesos in an exchange I use as WorldPay in Mexico. Here, they will be converted automatically to USDC, and then through a Fireblocks vault would be moved to an off-ramp, to a Circle account, for example, and then sent to a bank account. Well, sorry, this is Signature. We don't have that bank anymore. Let's choose Silvergate. Oh, we don't have that as well. Okay, so maybe we'll add another bank, but basically we can send this directly to a bank. And if I'll do this manually, what it shows is that if I want to move 100 Mexican pesos from an account in Mexico to a bank account in the US, it will show, okay, this will be $5.6 eventually. It will take around 9 minutes to do this, and it will cost around 7 cents. And here are the different steps. This is done, for example, here on USDC over Stellar. First step will be the conversion, then movement of funds all the way down to the bank. And this is just an example of another flow that TSPs like WorldPay are now using to move money faster with better cadence. Before we run out of time, I actually wanted to ask you, Nabil, I stopped the demo. And maybe I know I'm stealing Chan's thunder here. I don't know if he's already out there in London. Like, what really motivated you guys to be sort of the first player in the world to do this?
So I would say two things. One is, as you mentioned, we've been a first mover and an early adopter in the crypto space, and a lot of our crypto clients prefer to operate their businesses using stable coins, whether it's USDC, USDT, USDP, whatever it might be, because as a currency, it more accurately reflects the timeline and hours in which they operate their business. So for example, if you think about a crypto exchange, it's a 24/7, 365 enterprise that prioritizes speed of execution, liquidity, currency availability as selling points for its customers. And if you think about traditional fiat rails, in most parts of the world, even some of the parts where there's, fairly quick, real-time, and fully available payment systems, most of them still have challenges on bank holidays. Most of them still have relatively low payment limits when it comes to institutional use cases. So for example, faster payment system in the UK, it's great as a retail user, but if you're a business, there's a £200,000 transaction limit. If you're trying to move a lot of money over the weekend, you got to wait until Monday. So for a variety of reasons, these crypto companies that are our clients, expressed a preference for stablecoins. And so we wanted to obviously serve them because they're our clients. The second thing is just more philosophically, you kind of hit at this during the presentation, as a big payments company and as a broader, platform for other companies to build on, we want to make sure that we support all the rails, whether they're fiat rails or in this case, blockchain rails for our consumers. And I think as the world continues to move quicker in terms of iterative cycles and innovation, there's a need for the financial rails to keep up with that speed. And just to give like a simple example, for better or worse, I'm an avid Amazon shopper. I'm lucky to live in London, a city where Amazon has a lot of distribution centers surrounding it and can deliver goods very fast. But I could go on my iPad or my laptop tonight when I get home from work. I could order a few things and they'll probably show up at my door by lunchtime tomorrow. So from the time I place the order to the time I get the goods is, call it 18 hours, give or take, in London and a lot of other major metropolitan areas. But Amazon's probably not going to get paid for the goods that show up at my door tomorrow until tomorrow's Friday. So they'll probably get paid on Monday. So Amazon's in a situation where they've sent me something, I've received it Friday lunchtime. They're not getting money until Monday, and that causes a working capital issue for them. They're basically going into the weekend with a bunch of IOUs from all their different payment providers. And so a lot of our merchants who have very high velocity businesses where the goods or services are traveling faster than money, which in a lot of today's economy is the case, they're thinking about ways where they can cut that working capital exposure, which, particularly given the high interest rate, high cost of capital environment that we're in today, is exceptionally valuable for them. So those are kind of the reasons why we find this super interesting.
Thanks. And I know that Chen is probably waiting in line for London with the upper guests. So Chen, to you.
Thank you, Nabil. Thank you, Goldie. Great presentation, and we'll decipher a little bit of more as we go through the panel later today. But I'm now joined with Peter and Chen. I'll let them briefly introduce themselves before I request Peter to start with his presentation.
Good evening, good afternoon, and good morning to everyone. Thanks for having me here on today's session, Muneeb. Much appreciated. My name is Peter Left. I work for Lloyds Banking Group. I work in our group corporate treasury function. You might think, why on earth is he and Lloyds talking here at a blockchain summit? I suppose it's probably important to say, we believe in exploring the value of the technology. I know some of the previous conversation was a little bit more in the crypto stablecoin space. I'd say I need to distance myself from that a little bit if I'm allowed. For us, it's all about exploring the use of the technology on currently regulated money and maybe looking to engage with other forms of money as it potentially becomes regulated. But the regulation is pretty key for us. So we do think the technology can make money smarter, maybe solve some of the previous problems around the product arriving before the money, for instance. That's not a great customer journey, is it? So we'd love to solve something like that by applying the tech. And I guess why Treasury? Well, I mean, I used to manage the funding and liquidity at Lloyds. And obviously, the way you manage and fund a bank is to make sure that people have utility in holding deposits with you. And part of that utility is making that money useful so you can make payments quickly, efficiently, effectively, etc. So from my previous role, I started to realize, gosh, it's going to be important to make sure that we invest in making our money, our deposits as smart as possible so we can keep doing the credit creation and the lending to the UK economy.
Perfect. So, hi everybody, my name is Chen. I lead EY's technology consulting in blockchain in the US. And what we do is really exactly this point of connectivity between the crypto industry and the capabilities that it is bringing. And in Goldie's and Nabil's presentation, eventually both sides are fiat regulated, right? And the fact that they use I'll call it in the back end USDC in order to make it more efficient doesn't change the fact that what is eventually exchanging hands in terms of value for money is regulated currency. And what we do is help organizations not only understand that, but also integrate to the technology, for example, to the Fireblocks custody capabilities, to the rails that they provide, and connect back to the backend systems of the bank, and to do all of this in a safe and sound, risk-managed manner that would get the regulators comfortable. And I believe this is the future. That's why we're talking about it.
Thanks, Chen. And I think that's what the agenda for today is, future of payments, and we'll dwell into that more. But before we go into the panel discussion, so Peter, if I could request you to please go through the regulated liability network for us.
Thank you. And I sort of introduced this as the UK regulated liability network. It's, let's say, a version of that white paper vision that and it's there for all of us to interpret. Really, I see it as a banner for us to perhaps try and co-create and work together to create a future where we start to merge the technology, distributed ledger technology, with commercial bank money, with central bank money, with e-money, with regulated assets, potentially other regulated forms of money in the future. And I firmly believe that the opportunity there is squarely in the middle of merging those two things together. And I highlight it as UK regulated liability network. I mean, that's where Lloyd's is focused. But there's a domestic network with my view of the UK regulated liability network, and that's where we can bring all of the UK participants together, share that information to make the journeys for the money movement smarter, etc. But hopefully then we can partner with other teams around the world that might have rallied around similar concepts underneath that regulated liability network concept and banner to build sovereign networks for their jurisdictions, make sure we're maintaining the resilience of regulation, so we can have regulation of the UK network, regulation of the European, the US, etc. And then maybe that way we can improve cross-border payments. So perhaps the previous example around Amazon can probably deliver packages cross-border faster than the money might move at the moment, and we really need to sort that out. So what do I mean in terms of applying distributed ledger technology to money? I mean, it's a private blockchain. While we believe in the technology, we also believe in the resilience of traditional financial regulation, which I kind of think means it needs to be a private blockchain. And I know that obviously frustrates some, but I think, let's say baby steps. Would facilitate the programmability, be fully regulated, as I say. It would be stable value. That's not because I want to associate it with stable coin, but I would argue the original stable coin, was a sterling deposit in Lloyd's Bank 300 years ago. Right? Wow. So, and that's been regulated and finessed for the last 300 years, and I would argue it's pretty resilient. But now we want to make that deposit a bit smarter. And we think we can make that smarter by bringing more people into the network to participate in the journey. So it might not just be banks, but user stories might include the delivery, DHL and other delivery agents or insurance companies and Royal Mail and these sorts of things. So, and a shared network where everyone can come together to provide the necessary information to make the money move at the fastest possible speed. So how do we think we can try and achieve this? So we bring all of those people together in the UK. Hopefully there's a similar outcome in other jurisdictions, and we can build an interoperable network. But what's our foundation? So we're starting to think that that foundation is the synchronous movement of data and money. So I say this because I'm not quite sure why I'm seeing Onyx by JP Morgan on this slide, so we should probably make sure that there's no association there.
Yeah.
Sorry about that. So I think some of the reasons we just talked about there being frictions of money moving across border is everyone in the chain is having to do their own data validation and sort of source the same data again and again. So if we can try and make sure the why moves with the money, then the hypothesis here is that the money can move much, much faster. We always want it to be on, and we want that programmable settlement. So that's our sort of core functions that we think should be available, and they're operating on this private permission shared ledger where hopefully central banks might agree to come and participate, commercial banks might tokenize their deposits. And I say tokenize, I don't think the technology changes the nature of the money. It's still a relationship-based deposit. But if we put it on a network like this, we'd hypothesize that it could move faster and be more useful. And obviously, therefore, users might choose to use it more so than other things, etc., or continue to choose it, shall we say? And it's inclusive for those that are regulated. So we would include e-money issuers, other regulated FMIs. And what do we think if we build this foundation, this house? I mean, to borrow Augustine Carsten's language from the BIS, that's kind of like our smartphone. We think if we build this homogeneous, interoperable environment, we can have new fintechs, innovators, new third parties, and the current incumbents deliver, applications that can run on top of that. They can, write their user cases, participate in that network, be signing transactions because they're part of, validating the data, etc., and things like this. Sorry, did I? Okay. Sorry if you've lost the slides there. Apologies. There might be smart workflows in terms of anything that could want to act on that money. So a security, a loan, signing things off with your digital identity, making payment versus payment outcomes for on-demand international finance. I think there's a number of apps that could send their smart workflows down to this shared ledger environment on the regulated liability network to then operate on those forms of regulated money and hopefully make them smarter, more useful, and maintain demand for those forms of money as a store of value. Thank you.
Thank you, Peter. Very helpful. In fact, we have a couple of quick questions that we might be able to take just in the context of your presentation here. I think the first one is about how does blockchain and DLT make remittances faster rather than using traditional mechanisms of doing it?
Well, I think it's the key about the data moving with the money, the why.
Right.
So we would hypothesize that you can pass sanctions faster if you've got the why moving with the data. And because you've got all the information of the why in the smart contract on that, acting on those tokens on the blockchain, with the appropriate permissions, we can probably find the right way of sharing that, having an element of reliance on each other for that, so that that process can move a lot faster.
Perfect. So there are a couple of more questions, but in the interest of time, I think we'll press ahead with a panel discussion, and we'll take some Q&A towards the end, time permitting. So with that, right, so we heard two different sides of the coin today. So we heard Nabil and Goldie talking about the crypto side of things. We heard Peter talk about the regulated side of digital currencies. So Chen, let me put the question first to you.
Can I say something before? I think that the difference in what we heard is while Fireblocks WorldPay are utilizing the public blockchain in order to move fiat around, right? Again, it's just they are using the infrastructure of a public blockchain, but they are still fully compliant and mostly see value in the cross-border sense of things because it is a global network. what we're seeing Peter talk about is a more centralized, closed network that would get the regulators and the traditional financial system more comfortable faster. So it's not the way I see it. They are all both on the same spectrum. One is utilizing a more global network. The other that is more open. The other is more controlled and centralized. And it's really a spectrum rather than two different solutions.
Absolutely. I think it's a spectrum, and that's why the session today is future of payments. We're talking about all different variations, all different methods of payment. So if you think about right, so if you think about the broader spectrum in terms of where it's headed, right? So what in your mind is the evolution, right? What is the future of payments?
So I think that we will see the payments evolve in a few parallel paths, meaning if I look at this spectrum we just spoke about, on the one hand we will have full-blown CBDCs that are released. On the other hand, we will see the likes of USDC and stablecoins that are not what both these solutions talk about. And these two solutions are somewhere in the middle. We will see CBDCs, stablecoins, tokenized deposits in all forms of ways, and solutions like the FIS Fireblocks one, all coexist and evolve at the same time. At least for a while, they will coexist, and regulation will highly influence where this goes. I think that the technology challenges are more or less, not that they're easy. Privacy is a really good example that EY is working on. We will see them evolve and eventually solved. Regulation being able to catch up with all the changes so quickly is what will determine the rate of this parallel evolution. What emerges successful in the end, I'm not sure only one. I really don't know.
So let me pose that question to Nabil from FIS. So Nabil, again, same question to you, but in a sense, if you think about what Chen mentioned, it's a spectrum, right? But you have been working with Fireblocks on enabling transactions in cryptos, obviously with the on-ramp and off-ramp and fiat, and considering all the regulations in purview. What are the barriers that you faced in terms of rolling this infrastructure out, or how is this infrastructure evolving in terms of adoption and usage today?
Sure. So just to answer the first question, in terms of what's the future, I largely agree with Chen. I think there's not going to be a future where it's just CBDCs or just stable coins or just a continuation of existing ways of digitally representing fiat currency. We view scenarios where CBDCs, stable coins, utility coins, existing forms of digital money, and cash, to be honest, will continue to coexist for a very long period of time. And this is kind of why I spoke about earlier. We're agnostic. We're a platform. We will aim to support any and all of those. And I think, to Chen's point, you will find people where maybe they have less concerns with some of the philosophical or privacy-related elements of CBDCs, and they'll be happy to use it. Maybe there'll be people that have concerns but still want the speed and efficiency of a digital asset, so they might use stable coins. And then you'll have people who really aren't bothered and they're happy with the way things are today, and they'll continue to use their existing digitally represented fiat and their existing payment methods. And I think if you look at the payment or consumer payment ecosystem or landscape, I think you've seen this thesis play out. There's a handful of markets like the US and UK to some degree where it's still very dominated by debit and credit cards for consumer payments. But if you look at places like Latin America, Africa, Southeast Asia, and a few other regions, it's an extremely, extremely fragmented landscape. And so I don't think it's one or the other or even few. I think it's a future where there could realistically be many, because we've seen that in other areas of financial services. So that's the question, or my perspective on number one. On number two, I think there are a lot of challenges. I think you could go through any list of functions that need to get comfortable in an enterprise the size of ours, and there's probably been at some point in time, or maybe still today, concerns with various different elements. I think starting from the basics, blockchain is a new technology for most enterprise organizations, and so There's been technological challenges. How do we integrate simple things like ingesting data into our existing ERP and GL systems, or doing reporting and reconciliation with our existing analytics dashboards and reconciliation processes. So really kind of the basic nitty gritty stuff of like, how do you actually run a financial services business? There's a lot of challenges that have had to be overcome. Obviously, you can't talk about crypto or stable coins or any form of digital assets today really without talking about the compliance and kind of overall regulatory landscape angle. And those challenges have been in the space, continue to be in the space, and probably will continue to be in the space, but for different reasons. I think historically the challenge is that there weren't really guidelines. Today, the challenge is that there are guidelines in some places, there aren't in others, but sometimes they're ambiguous, so they're difficult to implement in practice. And in future, maybe they will be more black and white, more clear to implement, but a lot of legwork to get to that point in time when you're on the right side of it. So I think those challenges will continue to exist. So I think like I can go on and on across the different functions, within a company like ours. We can talk about how you orchestrate or integrate a blockchain technology like we did. We can talk about the legal and compliance side of it. We can talk about the accounting and finance side. We can talk about the tax side. And look, I think with any new technology or innovation, those challenges exist, whether it's blockchain or not blockchain. So from my perspective, I think good organizations in terms of adopting new technologies, this won't be anything fundamentally different from when you've had to do other things. I'll use draw a parallel to, cloud, right? 10 years ago, enterprises were absolutely scared out of their pants of relinquishing control of their data to physical servers in the control of someone else. Now that's like super commonplace, and people might think you're crazy if you're not deploying new applications on a public cloud. So I think it's just part of that journey that the enterprise space goes through, which of course in financial services tends to be slower than other industries.
Great points, Nabil. And I have a couple of follow-on questions which I'll come to. But
sure.
Let me go back to Goldie for a minute. And Nabil, as you mentioned, for example, as end users and as merchants, we today have a variety of payment methods and options by which we can pay and accept payments. Introducing new forms of money, is it causing more fragmentation or is it leading to consolidation? And the question to you, Goldie, is where does interoperability actually play into it, and how much of an essence is for all these different forms of money to be interoperable to cause less fragmentation?
Right, it's a good question. I think right now, if you're looking at interoperability or how does the blockchain, is it really interoperable with fiat, or how seamless are these movements between different payment systems, between different rails? There's still a lot of friction, right? Especially with the fact that we don't have a lot of very good on and off ramps globally. In the US, yes, you probably have at least 2 exchanges that you can count on. There's Circle. In Europe, we're slowly seeing, there are good exchanges, but it's still very, very much fragmented. And the enterprises are not feeling very comfortable to actually be in this environment from various reasons, like risk, right? Like WorldPay doing this was a big leap of faith, or a very big bet that they will be able to hold their clients' funds safe, right? And they did a lot of different, let's call that, mechanisms behind the scenes to ensure that. But as Nabil said, it takes organizations a lot of time to really practice and experience the movement between fiat to blockchain to crypto and back to fiat before they really feel comfortable with that. Looking at interoperability in terms of the currencies that we're using today to do this, I think there's a big, unfortunately, still a lack of interoperability. Again, companies in crypto are trying to solve this by creating protocols for atomic swaps or bridges or a lot of different ways to do this. We're still not where I would want us to be. In the future, hopefully, if Colombia issued a CBDC and there is a stablecoin in the UK by a big financial institution, you will easily be able to swap the two with a smart contract or something like that. We're still not there, obviously, and that puts a hurdle in creating a lot of payment corridors globally. But I think that's really, it takes time. Like Nabil said that, things take time with enterprises and in the financial industry as well. I had a bank that told me like a few weeks ago, he said, I don't know why you guys from blockchain on crypto are complaining. Like you only invented this 10 years ago. We're already implementing it. In banking, that's actually fast. Like you would be surprised how fast that is. And there's something I said in the EY blockchain conference, I want to say 4 years ago, the first time Chen invited me. It was about AI. I don't know if everyone knows, the first time there was an AI conference was in 1957 in Dartmouth, right? It took about 60 something years for ChatGPT 3.5 to get to the public, right? So I'm not saying blockchain will take 60 something years, and payments, I actually think we're already there, but we probably have a few, like 5 more years before we have a lot of interoperability between stablecoins.
And I would add at least the way, the EY view of how do we reach this interoperability faster is regardless if you are comfortable working on public rails or less comfortable and then you are working on private rails, and JP Morgan Dollar is a really good example of that. And I know there's many other banks in the US in the very same situation where in the current regulatory environment, they simply cannot work on public infrastructure. The way to keep or to reach interoperability sooner is to adhere to these public standards, both in terms of protocol and in terms of token standards, for example, because then even if you get the different banks all developing their own solutions, adhering and rigorously adhering to these public protocols would mean the lift for interoperability is much, much easier and is almost there by design.
Sure. Thanks for putting that point across, Shane. Peter, if we, obviously we heard from Nabil and Goldie about interoperability and, Chen mentioning the confluence of private and public ledgers, etc. But if you take technology out for a minute, right, and if you think about the macroeconomic effect of digital currencies generally, so where do you as a banker see that manifest, right? So where does the future lie with respect to the macroeconomics of it?
Well, so I think money at the moment is a key form of credit creation. Money is created by banks, commercial banks that have a license to do so. We have to have capital, we have to meet all the regulations, and if we have enough capital, then we can make that loan to help someone buy their house or fund their shopping purchase that week, or buy their car, etc. And that is when we create money, when we make that loan. And ultimately that money has to come full circle back to a bank. So the person who sold the house to the person who lent the mortgage money to, will then maybe repay their mortgage, or they might not have a mortgage and they'll now have a big deposit, and that might be a deposit back at Lloyd's. So if we move away from the key store of value being the money that supports credit creation, then I think we've got some real risks to the rate at which economies can grow. If everyone starts moving towards a stable coin that's backed one for one by cash at a central bank or something like this, then how do we provide the credit to society? How do we get the most potential for the citizens of the UK and the countries we all represent? How do we help lift them up and give them the opportunities if money moves substantially away from supporting credit creation? So I think we have to be a little bit conscious of the designs of money and think about how much each of those might factor in.
Sure. Can I, I'm listening to what you're saying, and I think there's two answers in the long term. So I think that we in EY don't have a doubt, and coming back from consensus 2 weeks ago, most of the large banks, at least I met with, don't have a doubt that the eventuality is public blockchains, even if right now it's harder. And when money becomes global, a lot of the liquidity and credit creation that you are talking about will be there, even if we change the current way things work, that is literally limited by the more analog, segregated way that we're doing it. Add to that there will be new ways to create uncollateralized credit, also in this public blockchain future. I would say that longer term, we will find new ways to create this value that you are talking about without the need for a bank in the middle to create this money out of thin air, like the fractional reserve system works today. Further out, but still, I'm optimistic.
Fair point. Now, and with respect to RLN generally, then, right? So, what is your view in terms of how, for example, this new regulated infrastructure within UK is going to change the paradigm of payments? And should we be looking only, to your point earlier, on the settlement side, or is it the settlement and data together forming a powerful combination?
Yeah, I think you've got to have the data moving with the money. That is the key to making sure that, one of the reasons that I think sometimes it's harder for regulated money to move as fast is because we've all got to do quite a lot of checks to make sure we're adhering with global sanctions regulations and KYC and AML. So that at the moment probably creates quite a lot of friction. A lot of people would say that's important friction. I would, but we need to perhaps maybe not remove the friction, but make that process easier to satisfy. And I think you do that, by having the why and the money moving together. So if they're described on that same shared ledger and that everyone involved in the transaction, with appropriate data permissions, etc., can see that why, then that money can be moved at the right speed, at the required speed.
Perfect. So I have a stupid question maybe to Nabil. Nabil, how are you solving this today, right? You're already moving money around cross-border, and you need to adhere to all these data requirements and all this friction, and you still do it faster. So how?
Yeah, so it's a very broad question. One thing I'll say is, rather than saying the data needs to move with the money, I'd say the money needs to move with the data, because the data is moving faster than the money. But generally, I agree with the principle. Second thing is, I think it really depends on what sort of money flow you're talking about. So I think there's some things in the way consumer payments work today that are just systematic or out of our control to change. So for example, how quickly an issuer bank has to pay the card networks and how quickly the MasterCard or Visa or Amex or whatever networks pay us. Those things are governed by those networks, and we can lobby them or influence them or provide our perspective, but ultimately some of those things are out of our control. And so what we're really focused on is like, what are the things that are in our control where we can accelerate or make more efficient? And for something like card payments, settling that final leg with a stable coin might speed up the time from when the money hits us to when it hits the merchant's wallet. So that's an area we're investing in. A lot of other payment companies, for example, are investing in either using their own balance sheet capital or using third-party capital providers to do what's called pre-funding of settlement. So for example, if we know we're going to get money that we owe to a specific merchant tomorrow from Visa, MasterCard, maybe we'll pay them today, or a third-party capital provider will pay them today, because the credit risk of Visa and MasterCard is pretty dang good, especially because that transaction is already approved by the bank that owes Visa and MasterCard the money. I think there's ways that companies are bridging the gaps to accelerate the way or the rate at which money moves, but you have to acknowledge that in financial services today, particularly in consumer payments, there are, for better or worse, a lot of intermediaries that money needs to move through. And, as we all know, to some degree, it's out of our control what those intermediaries will or won't do, or be willing to accelerate or not. And then I really like the point around deliberate or useful fiction. I was trying to rack my brain when you said that, but there was one of the either neobanks or consumer-facing wallets, I don't know if it was PayPal or Cash App, and they actually said, having completely friction-free money movement isn't something that consumers want, at least on the retail side. When you go to send a peer-to-peer transfer today in the UK, if you're using most of the apps, they'll ask you, have you sent money to this person before? Did you already receive the good or service? Are you sure this is the right amount? And research actually shows that consumers like a little bit of that friction and being asked those questions because it gives them more assurance that that money is actually going to the person they intended to for the goods or services or purposes that it's intended for, and it is the correct amount. So I think there is some, degree of value in what I'll call useful friction in the financial services ecosystem, whether it's giving consumers increased confidence that their money is being, again, sent to the right places or for the right purposes, or that, we're meeting our sanctions or anti-money laundering obligations, et cetera. And so I don't think the panacea is completely instant and frictionless. I think it's somewhere in between that and where we are today.
Great point. And Goldie, in conjunction with that, right? So if you think about some of the real-time payment systems globally, and including in UK, for example, we have CHAPS now moving to 24/7 real-time settlement, etc. And CHAPS has also come back with the Bank of England saying that they can play the role of, for example, with the synchronization operator sitting in between, play the role of providing the delivery versus payments at atomic level, right, with asset ledgers. How does that impact the overall process by which we are thinking, stablecoins are more pertinent, or, for example, digital assets could have played that role much more efficiently. But now you have existing payment rails exactly trying to do the same thing. Where does it come together?
Yeah, so the point I always try to say is that essentially, a lot of the times locally, we have good systems. Like CHAPS would be great. There's RTP and soon FedNow, maybe in the US. There's SPAY in Mexico. The problem is the challenge we're facing globally, and this is why, again, Fireblocks, we work with a lot of companies that work globally, like WorldPay, is that CHAPS is not talking to FedNow. FedNow is not talking to PIX in Brazil, and that really is a lot of the volume globally right now, because obviously merchants are global, WorldPay processes globally. A person in Singapore buys something from a merchant in the US, right? So I think that is where stablecoins are probably going to play a major part right now. But what I really believe is that over time, when the British government will create a CBDC, then CHAPS would run a stable coin. Maybe that would be, because that's what we're all hoping for, the interoperability, where the CHAPS system, because it would run a stable coin and would incorporate blockchain in it, would be way easier to integrate into whatever the US would build, for example.
Interesting point. And I think we just need some closing comments now because we're almost top of the hour. So Peter, closing comments from you, and specifically to the point that Goldie just mentioned, right? CHAPS running a stable coin in UK in conjunction with CBDC. Any views?
Well, CHAPS already runs a stable coin. It's just a liability issued by the Bank of England. They've been doing it for nearly as many years as Lloyds has been doing it, basically. I think my closing comment is to probably borrow Nabil's phrase. I really like this idea of, I've been prioritizing the money and thinking the money moves fast, but you're right, Nabil, it's, I need to get the money to move as fast as the data. That's my challenge. That's my takeaway. Thanks for that. I'm going to copy that one.
Fantastic. Chad, some closing comments from you.
I'm just excited to see how this space evolves. I think that one aspect of making all this more digital and more fast will have a lot of implications on privacy and this data that with the money that we're moving so quickly will create a lot of challenges in terms of what you can do with this data. We didn't say AI even once the entire time, so kudos for us, but connect that with what AI could, derive. That's another point that we will need to solve. And again, it goes back to getting privacy right. We'll see where it goes.
Fantastic. Thank you so much for an exciting panel. And we'll see you shortly after a quick break. So see you back in 25 minutes. And thank you for joining us today. Thanks all. Thank you.
welcome back, everybody. Next hour, we're going to have 3 quick discussions, 20 minutes each on on managing digital asset risk. I think that, at least from what EY is seeing, we are helping organizations strategize on how to implement this technology. We are helping organizations implement the technology, but just as important, we are helping organizations manage risk and build risk into their solution by design, and of course stay compliant, safe, and sound. And that's going to be the topics of the next 3 sessions. With that, I will transfer to Brian. And first of all, please start with introductions and then have the discussion. Brian, to you.
Perfect. Thank you, Chen. Hi, everyone. Good morning. Good afternoon. I'm looking forward to this discussion on the topic of digital asset risk, as Chen mentioned, with one of the leading institutional asset managers in the digital asset space, Grayscale. So to kick off, I'm Brian Stern, a senior manager in our digital and emerging tech blockchain practice. Within the team, I lead our blockchain strategy and risk efforts, where we help our clients build and engage with digital asset products and services such as custody, execution, tokenization, and a whole host of other capabilities to build out in an institutional grade way. I'm thrilled to welcome Ed McGee, the CFO of Grayscale Investments. Ed's been with Grayscale since 2019, and prior to his time at Grayscale, Ed held leadership roles at Goldman Sachs in accounting policy and SEC reporting, and prior to that was an auditor at EY. So Ed, welcome. Thank you for joining us today. To get started, maybe for those in the audience who aren't familiar with Grayscale, could you start by sharing some background about the firm and the products that you all offer to industry?
Of course, Brian. First of all, thank you for having me. The conference seems to be going well, and feel really fortunate to be able to speak with you about everything that's going on in the industry, and first and foremost, Grayscale. So as you mentioned, I've been here since 2019. We currently offer 17 investment vehicles. We have the world's largest Bitcoin and world's largest Ethereum investment vehicles, all domiciled here in the United States. Outside of that, we also have a securities-based ETF, and we recently announced just yesterday the expansion of that franchise. Now, that's where we are today, but if we look back to where when I joined the firm in 2019, we had and everything about our organization. So that includes headcount, legal entity structures, our investor base has expanded, so communicating with those investors has expanded. And we feel really proud about the way we've been able to grow our product suite, engage with regulators in a proactive way, and offer investors the ability to invest in products that are very familiar to them. These are passive investment vehicles that we operate in a security form that is very familiar to brokerage houses and risk managers, so that they could effectively deploy their thesis in this technology, in this asset class, in a way that is wrapped with a legal entity structure that is compliant. We are SEC reporting for 9 of our products, and that's on a voluntary basis. And so that gives you a flavor of where we are, where we've been, where we are, but we're really excited about where we're going.
Perfect. Thanks, Ed. So when you talk about your growth, could you touch on some of the challenges that you at Grayscale have really hit on as you've grown from, an early stage asset manager to one that's now seen as one of the leading for institutional investors?
Of course, it's been an evolution. And as I mentioned, we added legal entity types to our organizational structure, and those include registered broker-dealers and registered investment advisors. And so to go from a space that, from an asset management space, where we were early in the adoption of putting digital assets under our investment portfolio or investment vehicle structure, we've had to now lean into those regulatory bodies that seem really familiar for traditional financial professionals. Things like broker-dealer requirements here in the US, registered investment advisors, the regulatory oversight of those vehicles. is sometimes taken for granted by those that live in those spaces at big multinational companies, where the infrastructure for compliance, reporting, data maintenance, all of that is something that was usually pre-built before recent joiners to that firm. Now we've had to add headcount, and like I said, our investment, our shareholder base has been diversified. We're held by a very diverse set of retail and institutional clients from a product perspective. When we think about making sure that we're growing responsibly, we want to be deliberate in how we engage with regulators, how we set up processes and include the right headcount in our organization to manage the risks that exist in any organization from a traditional finance perspective, but also those risks that are specific to digital assets. And so there are a lot of themes of risk management and business continuity planning and controls and written supervisory procedures that everyone can understand. But when you take those principles and stand up those structures within an organization, you have the ability to take the best from individuals' experiences, best from organizational structuring perspectives, put that all together and allow yourself to set up world-class compliance environments and engage with this novel asset class in a way that is familiar to not only the people in-house, but investors. So those are things that are as simple as segregation of duties, safeguarding assets, and you just have to layer on this concept of digital assets to tweak those organizational pillars in a way that protects those assets.
Excellent. Thanks for that. When we look at the global regulatory environment, there's increasingly a divide in how different jurisdictions are regulating crypto and digital assets, with APAC and in particular in the EU with recent MiCA regulation taking shape and providing clarity to the market. Meanwhile, in the US, where Grayscale's based, regulators are lagging. How do you approach managing the regulatory changes and keeping up with having, your institutional products and also your pipeline of institutional products be in sync with where the regulatory environment is heading in the jurisdictions that you operate?
It is difficult because of some of this uncertainty, but the way we manage that risk is transparency and constant communication. We appreciate that it's a very difficult task, regulators in any jurisdiction and members of their governments in any jurisdiction, to evaluate this asset with everything else that's going on in the macroeconomic environment and structure common sense regulation for an asset that is going to exist and is going to be in part of investment portfolios. And so from our perspective, it is that two-way communication, leaning on service providers, leaning on those that are constantly monitoring the industry, not only within the US capital markets, but abroad, as you mentioned, and evaluating what has worked, what is gaining success, what is gaining traction, so that we're aware of any non-US regulation that may be mimicked here in the US, and ensuring we're prepared for that. But again, it does go back to this communication of understanding from a regulatory perspective here in the US, the why behind proposals or different enforcement actions. I think having an understanding as to what a regulator is thinking and having the opportunity during comment periods to engage with a regulatory body to put forth your perspective on what their proposals are really important. And so if you do not have that constant communication, you can be caught by surprise. And even if you have that constant communication, you can still be caught off guard by an announcement or an enforcement action. And from there, to manage that risk, you of course evaluate what that does to your organization, our investment product specifically. If it impacts us, we will address those risks. If it impacts our products, we will address and disclose those risks very transparently, very timely. And then you have to broaden that evaluation to your service providers. There are different service providers, such as custodians, administrators, assurance providers, all providing services to this industry. And you want to make sure that they are on top of developing regulations, that you understand how they might impact their businesses and their ability to continue servicing you at a level that you need to really satisfy and stay abreast of everything that's going on in the space.
So Ed, you touched on something around two-way communication with regulators. And I would imagine that was pretty critical in terms of your engagement with the SEC. So Grayscale had the first crypto investment vehicle that was an access. Could you share what that process was like getting that product registered? And if you touched on some already, but if there are any other lessons learned you would say for others who are looking to engage in that process?
Absolutely. So that was a long process. And fortunately, in the US, that type of communication is publicly available. The written communication between the SEC and Grayscale is fully available on the SEC site because, as you mentioned, we voluntarily took the product because we want our products as far within the regulatory perimeter, whatever the perimeter may look like, at all times. And so that was a long process, especially for the Grayscale Bitcoin Trust, because it was the first of its kind. So there was a lot of communication, there was education on both sides of that communication to understand how we were approaching it from a risk and disclosure perspective, how we were approaching the asset from an accounting perspective, how they were evaluating the asset and their perspectives on those same matters. And the two-way communication was frequent, but it was critical to make sure that if we felt like there was questions or comments that were honing in on something that we felt was important, we would absolutely disclose it. But we also wanted to have that communication to make sure that we could impart on the SEC and the branch that was working with us what we thought was important and why we were highlighting certain things about how the asset trades, where the asset trades, the liquidity, the fair value measurement of that asset. And so the lessons learned that others might benefit from are really making sure that you have the time and the patience to work with and educate each other. And that type of constructive comment period dialogue will only help investors, and it will only help your organization stand up and disclose to your investors if you do have products that have exposure to digital asset in a framework that makes sense to not only your regulators, but is now consistent across the industry.
Excellent. So from some of the sessions earlier today, protecting customer assets, protecting the custody of assets has been a big theme of what's been discussed. Over the past 12 months, there have been a series of crypto and digital asset company failures, which were exacerbated by, in many cases, just broad inadequate internal controls and segregation of custody of customer funds. What steps does Grayscale take to ensure that custody of funds and underlying assets are secure and properly managed?
Absolutely, and those instances are really unfortunate. But like you said, they were failure of internal controls in certain processes that could have been mitigated against. This is not novel. This idea of segregation of duties, having oversight, having a compliance framework, a tone at the top that lives and breathes protection of especially customer assets. In our instance, and to be clear, our investment vehicles are passive investment vehicles that are fully backed by the digital assets. And so they are very easy to reconcile. We account for them. We perform a lot of controls and procedures and communication internally to make sure that we know where the assets are at all times, when they're moving, why they're moving, and how they're moving at every instance. And from a safeguarding perspective, we've worked with who we think are best in class in the industry. And our custodian is publicly disclosed in our filing documents, and the exposure we have to their risk and compliance teams, their technology teams, is really important. And not only is having the access important, but it's really arming yourself internally as a company with either the expertise or the right assurance providers, or having access to a third-party assurance provider of your client, so that you can come at the evaluation of private key maintenance, how they store the private keys, how they bring them online. All of that becomes critical. And if you don't have the right people with the right expertise understanding not only blockchain technology, but how that organization is setting up an environment around the protection and safeguarding of those assets, you could set yourself up on a pretty dangerous path there. And so at Grayscale, we are constantly evaluating the control reports of our custodian and safeguarding those assets. And we are also canvassing what else is out in the market. we need to, and we owe our customers the obligation of understanding what is the best technology, where are assets safely held, what are the contractual terms within not only our existing contract, but the at-market contracts that others may provide to evaluate things that are not specific to digital asset, bankruptcy risk, the risk of corporate failure, that's not related to just their financial wherewithal. All of those considerations have to work their way into third-party vendor analysis, backup and redundancy providers, business continuity planning, and then really making sure that that diligence that most organizations do at the outset, and then maybe once annually thereafter, is a lot more frequent, given all the different events and circumstances and changing landscapes within our industry. It has to be top of mind and remain a lot more frequent than an annual evaluation.
So you touched on a lot, which is common across, that's not new to this ecosystem, or where you have enterprise risk management functions, third-party risk management, and critical and segregation of duties, things that are not new to folks, right? But when you look at the difference between traditional finance and the digital asset and crypto space, what would you say are the key areas of differentiation, right? Where they're the uniques of cryptocurrencies and digital assets, where your organization really has had to differentiate itself?
It's likely focused on the speed and not trying to meet the capabilities of the technology. Digital assets can move very quickly, and if they're supported correctly, they're sometimes non-recoverable. And so that understanding that what might exist in the traditional finance space is different for digital assets forces you to evaluate from an organizational perspective. What works for a banking or a fiat segregation of duty? Is that the right setup for digital assets? As you said, the principle and the concept is the same, but do you have the right layers of oversight, the right responsibility, delegation within your organization to make sure that no one can act on their own? Because single actor points of failure are terrible in every circumstance, but they're specifically risky for digital assets. And I think differentiating yourself in the regard of having the right people, the right processes, and the right communication internally, so that there's eyes on your assets at all time, is critical. And it cannot be a situation where you evaluate something on a quarterly basis or a monthly basis. I think that the constant oversight, evaluating the nodes, reconciling the information to the blockchain yourself, if possible, are really important steps for organizations to think about taking, so that if there is an issue, they can react quickly.
Thanks, Ed. So another area of focus has been around the concept of counterparty risk. So how do you manage counterparty risk when working with various digital asset exchanges and vendors? You touched on your custodial due diligence processes. How do you all think of counterparty risk and the challenges that it presents in this space?
Yeah, it's a similar theme to something I mentioned, but on this point specifically, is diversification, of course, and not only diversification in, do I know who is in the market? Do I have the contracts ready? Do I understand them? Have I connected the operational pipes? Do I have the relationships built out on a redundant basis? And in this space, if we've seen anything, and I guess this is true for the traditional finance space as well, when you look at some of the smaller regional banking issues here in the United States, is one layer of backup may not be enough. And two is probably sufficient, but three might be great. And that mindset of constantly evaluating your counterparties, their wherewithal, what their risk management processes are, the likelihood that there's concentration of risk for a similar event across each of your counterparties, and how you diversify that event, even if you have counterparty diversification, is important. So for example, if all of your counterparties would fail in the same scenario, that others may be more resilient to, you have to evaluate whether or not all of your counterparties are in that same risk profile, and how to diversify away from them for those events that might take out multiple counterparties in one fell swoop.
Excellent. That's extraordinarily helpful. Thank you for that insight. So Ed, it's been great chatting with you, getting your perspectives and what you all at Grayscale are doing from the perspective of instituting trust in the digital asset space with the products that you deploy out to market. Thank you for coming and speaking with us today. Really appreciate your time.
Absolutely. Thank you, Brian.
So,
back to you, Chen.
Thank you, Brian. Thank you, Ed. And if I took one thing out of your session is this notion of there's nothing new into risk management and the way financial services organizations are managing this risk. What is new is the new rails and the new technology and how you apply the same principles into a new technology. I think that our next speaker is exactly positioned to continue the discussion and answer these questions as he comes from the background of what I would call a traditional risk manager that deeply understands the technology, and both in his previous role and current role works in bridging this gap between what are sound risk practices and how do you apply them to the new technology. With that, Yusuf, to you, please.
Good morning, good afternoon, good evening. Thank you for having me at this global blockchain summit. Appreciate the intro, Chen. A little bit more about myself. Let me just take a quick look at the slide. Where are we here? All right. So a little bit about myself. Let me get the right slide first. We're looking to quick step back. I'm a managing director at EY, focusing on crypto risk specifically. I am an EY boomerang. EY was so nice that I came back twice. And it's great to see that EY continues to innovate and stay in lockstep with such innovative industries. But as I mentioned, I started off my career at EY focusing on risk management, spent the next bulk of my career at Goldman Sachs within their risk division, spent the last 4.5 years at Gemini Trust Company, the crypto exchange and custodian, as their chief risk officer, head of risk, responsible for all aspects of risk management, including enterprise risk, operational risk, market risk, credit risk, and insurance. Wanted to start off the conversation with, the events in the industry that have occurred in the recent past. This session aims to address core risk management capabilities that any org should have as they explore crypto opportunities, especially as the regulatory environment continues to evolve. Hopefully, crypto native firms learn a bit about what it means to establish a regulatory compliant risk function, especially as we gain further regulatory clarity. And then for the traditional financial institutions, hopefully, as you look to dip your toes in crypto, you get a glimpse of what the crypto specific risks are, what the crypto specific nuances are, and how they can mature the existing risk management capabilities that your organizations have. With that, all right. So I'm going to make a start with the recent sort of history over the last couple of months. So crypto's been making all sorts of headlines over the last decade, but unfortunately, as of late, the focus has been on the negative aspects of the industry. And I'll set that stage with the collapse of FTX, which isn't too far off in the past. But crypto, as I like to joke around, crypto is like dog years. Time in crypto is like dog years, and it may feel like that it's happened many years ago. But the FTX collapse is one of the largest bankruptcies in history, and it was enabled by severe deficiencies in enterprise risk management. I'm just highlighting a couple of these headlines that demonstrate exactly that. So you'll see risk management at crypto firms is in focus following FTX collapse. You've got the new chief that calls FTX's corporate control a complete failure. And you've got FTX had the corporate governance of a college fraternity. Now, hopefully we can change that as we mature and learn from the mistakes of the past. And I think we can't learn from the mistakes of the past unless we walk through a timeline of the past. Now, I'm sure most here have seen some variation of this FTX timeline. However, I wanted to overlay some of the risk management failures on top of that timeline. So as we go through this left to right, I'll just hit upon some of the risk management failures. So in May, you saw market manipulation occurring where FTX shorts, Terra and Luna, they employed a variety of market manipulative tactics to make their shorts profitable. In July, there was a significant systemic risk where the industry was intertwined and there was a slew of bankruptcies. And November is where everything just began to unravel. In November 2nd, you see a lack of internal controls around financial reporting, a lack of just overall financial reporting controls, which fall under the broader domain of operational risk. And you saw liquidity risk. And what you see here is when the FTX financials were leaked, yes, they had $10 billion in liabilities, but the reported assets, only $1 billion were liquid. Majority of the assets were held in an illiquid native token, FTT. Market risk, November 6th, you saw market risk play out with Binance announcing the sale of their corporate held FTT tokens. Imagine what happens when a highly illiquid token gets sold on the market. The price significantly dropped and led to panic. A few days later, you saw the bankruptcy of FTX. November 12th, you saw operational risk with the non-segregation of customer and corporate funds. FTX lent customer funds to Alameda, their sister market maker hedge fund, to make up for to make up for losses from their FTT token collapse. November 16th, we see credit counterparty risk as Genesis Trading, who was one of the largest FTX unsecured creditors, paused withdrawals. November 17th, you saw governance and enterprise risk, just broad swath statement from John Ray, the interim CEO of the FTX, stating that it was a complete failure. So as you see, there's a combination of financial and non-financial risks that led to the demise of FTX and a number of major industry players. It wasn't any single one contributory factor. All right. So just to recap, right? So in that timeline, you saw what happens when things fail, right? So recapping that, you see that when there's a failure in risk management, in addition to reputational risk, that's if your company survives, there are more severe outcomes listed on the screen here. So you've got regulatory enforcement and actions, you've got cease and desists, you've got criminal proceedings, loss of customer market share, customer lawsuits, impediments to a successful exit like an IPO, and then ultimately a bankruptcy. Now, the regulatory environment continues to evolve, and unfortunately, due to the collapses in crypto, people may say that US regulators have gone to one side of the extreme by regulating through enforcement. I think the 2024 elections will be interesting in the US as we keenly watch if any pro-crypto regulators are going to be elected and take a different stance, providing the clarity that the industry needs in the US. However, this is a global blockchain summit, so I'd be remiss not to mention the great regulatory clarity that's coming out of Europe and Asia. And just to name a few, you've got the MiCA regulation in European Parliament that was recently passed. You've got the Future Financing Act in Germany. Germany's BaFin has been one of the leading regulators in the crypto space. And then you've got the Digital Asset Basic Act in South Korea. So we watch with bated breath in the US as to how the regulatory environment evolves globally and hopefully can positively inform US regulations. Quickly here, risk management. I know a lot of organizations view risk management as a cost center. You lose competitive advantage. It's actually a competitive disadvantage. Some view it as that. But lack of spend on risk management isn't much of a competitive disadvantage when an organization goes bankrupt, right? So for that reason, I highlight that, risk management is a business driver. It is a revenue generator. It is a competitive advantage. It's a decision enabler and an efficiency tool. So hopefully we could change that narrative. It's not just the regulatory clarity, but it's the right thing to do. Risk management is a moat for those organizations that are still in crypto today, whereas other competitors no longer exist. So, as I mentioned in the timeline, there's no single factor of risk resulted in the FTX demise and the bankruptcy of other industry players. It was a combination of financial and non-financial risks. But to think about this holistically, this should look familiar to a lot of traditional financial institutions. And from a crypto native standpoint, hopefully this is helpful in what it looks like to have a solid, leak-proof roof and a rock-solid foundation that's risk management as a whole. And at the top, you've got core components of risk management that span across enterprise risk management. You've got foundational risk stripes around the bottom, such as operational, insurance, market, credit, and liquidity risks. Enterprise risk is the overlay. It's a key component driving consistency in how each of those foundational risk stripes assess and eventually mitigate risk. Ultimately, these risks need to be reported up to management and the board, both of which are fiscally responsible for the success of the organization. And just like how management and the board, meet on key product decisions, revenue, P&L, other sorts of KPIs, it is the responsibility of the board and management to report to understand the risks being taken by the organization as expansion occurs, as product launches occur. Another component of enterprise risk that I did want to highlight is this 3 lines of defense. Also should look very familiar to traditional financial institutions, but a little bit of a history lesson for some of the crypto native firms. 3rd line of defense, 3 lines of defense. You've got a first line that's responsible for implementing the hands-on keyboard, implementing controls. You've got an independent 2nd line of defense that's a risk management function that serves as a check and balance to any risks that the first line takes. And then you've got a 3rd line of defense, which is your audit function. Now, the 3 lines of defense was put in place by many traditional financial organizations in response to the 2008 financial crisis. Prior to the 2008 financial crisis, you had risk functions that were not truly independent, that were reporting up into the management or CEO. And what that posed was a conflict of interest, if you will, between management and the risk function, where the management would take revenue, profitability, undue risk taking over a more conservative approach. So as a result, a lot of the regulators, federal regulators in the US and others across the globe have set forth a set of requirements where you need to establish a risk function that is sufficiently independent, reporting into the board, so that you've got the same level playing field when reporting revenue, profitability. You also have the same level playing field reporting the risks that the organization is taking. So once again, provide some air cover to a risk function and provides the same platform to discuss risks, just as you would discuss business products, revenue, and profit. Okay. We'll jump a little bit more into, all right, we talked about products, risk really depends, risk management the approaches really do depend on the product. And in crypto, you've got a swath of different products. The technology enables, blockchain technology enables consolidation of a lot of different functions that you see in traditional finance. And as you look at these different products, they pose new risks, right? Different risks. So a risk function should have a deep understanding of the product to adequately assess the risk, whether it be a stable coin, whether it be an exchange or custody offering, or just asset management. And as you look at the products, like once again, depending on the product, different types of risks, right? So if you're an asset tokenizing firm, you're going to want to look at the smart contract itself, test it appropriately. New risks posed due to the smart contract angle. You want to ensure you've got, from a exchange and custody standpoint, there's various different steps in onboarding an asset, safekeeping an asset, settlement, operations, asset servicing, where there's unique risks there as well. You've got HSMs, you've got key management infrastructure that secure digital assets, and ensuring that you've got the right level of control, checks and balances in place, independent validation of your custody infrastructure is key. And then from a DeFi standpoint, DeFi is an interesting space in that there isn't any one centralized entity. Even in the crypto space, you've got centralized entities like crypto exchanges, custodians, and stablecoins. However, in DeFi, you've got a number of different risks that are unique to crypto, that are even more unique to crypto than the risks that I mentioned before that center around centralized finance. So things like impermanent loss, you've got, which I'll get into in a little bit. You've got smart contract security, once again, maximum extractable value risks, and then staking and slashing risks. So all in all, this slide is here to identify that the risks are unique depending on the product that's being offered. Now we'll jump a little bit into the non-financial risk before we jump into the financial risk. But briefly, as I mentioned, non-financial risks include key management, custody operations. You've got people going to and from data centers, if you will, or secure locations to go ahead and sign a Bitcoin or crypto transaction, to then broadcast out to the blockchain for actual settlement on chain. Talked a little bit about, due to the advent of smart contracts, you want to test to ensure that there's no backdoors. You want to have sufficient testing. You want it to be open source, right? So that you've got plenty of eyes taking a look at it where applicable, right? And where it's not open source, even if it is open source, you want to ensure that you've got smart contract code reviews that occur. From a compliance standpoint, you want to ensure that you've got ongoing monitoring and compliance above and beyond your customer onboarding. There's transaction monitoring that needs to occur on blockchain using tools like elliptic or Chainalysis to identify bad pools of actors that exchange with sanctioned wallet addresses or underground markets. Moving on to the financial risk considerations, crypto is highly volatile, and some digital assets are highly illiquid. As such, there are special considerations made to key financial risk standards, like calculating value at risk, calculating value at risk across market risk, for market risk, for credit risk. It is highly volatile. I can tell you that when we implemented market surveillance capabilities, not financial risk, but when we implemented market surveillance capabilities, crypto moves 20% any given day, right? So the tools that we were using for market surveillance were traditional financial industry standards, but a lot of tweaking to ensure that it can handle 8, 10, however many decimal points. It can handle moves of 20% or above, and are tuned appropriately. We've got specifically in lending, there's been a lot of conversation about lending risk, both in CeFi and DeFi. I'll touch upon DeFi previously, briefly. I mentioned DeFi allows the opportunity for people to earn yield by staking their digital assets in a liquidity pool. And then you potentially have impermanent loss, which is where your gains that from staking a token is less than the gains had you just held that token. So there's additional sort of unique market risk, credit risk vectors that need to be measured as part of measuring risk in the crypto space. And with credit risk, the volatility further compounds the credit counterparty risk. It's interesting to see that in early days, a lot of the lending occurred unsecured, and due to recent events, you see less and less of that. All right. And I think that's basically it. I think we've got a polling question after this, if I'm not mistaken.
So am I live? Just want to make sure. Perfect. Thank you. So Yusuf, one question we do have that came in and maybe you can help address is around counterparty risk and what tools and practices exist today that help crypto companies mitigate that risk. And any insight there?
Yeah, definitely some insight there from a credit and counterparty risk standpoint. You've got a lot of counterparties that are crypto native hedge funds, so there isn't much in terms of what you can leverage from an S&P and Moody's. However, you want to ensure that you're collecting financials from these counterparties. These financials include the cash flow, the balance sheet, the audited financials. All of that makes up an evaluation of the counterparty and the risk that they pose when you lend funds out to them. Furthermore, that diligence will inform what level of collateral a counterparty would need to post and how frequent that collateral management is a very key component here. Ensuring that collateral is sufficiently liquid. You don't want to have illiquid collateral. A lot of times you'll find that prudent lenders will allow Bitcoin, Ether, a lot of these more liquid tokens as collateral, and shy away from allowing collateral of illiquid tokens, given what happened with FTT and FTX. A lot of these credit risk capabilities are built in-house, as the crypto industry is still fairly nascent as the risk management capabilities continue to evolve. But more emphasis on process, vetting your counterparties, and ensuring that you've got appropriate collateral management practices in place.
Thank you very much, Yusuf. And moving on to our next speaker, if we said earlier, and I think that's the theme of this discussion, that the risk practices stay the same, but the new technology is different, and that is what we need to adapt and adopt. Our next speaker is going to talk about how we as EY see new tools emerging and evolving in order to receive the same result, but using new tools and the new capabilities that this technology offers. So with that, Graham, my friend, back to you.
Sounds good. Appreciate the intro, Chen, and good to be here. Let me go ahead and we'll get the slide going and off to the races. All right, so folks, appreciate you taking the time. Chen makes a good point about needing to make adjustments to the controls that you have in place in order to mitigate the risks unique to digital assets. With that said, there's far too many of them for us to cover in the next 20 minutes or even in the entire day. And so what we've done is we'll be here discussing with you one in particular, which is blockchain monitoring. Quick introduction before we jump into it. My name is Graham Cathcart. I'm the US Blockchain Risk and Operations Leader, fully dedicated to blockchain and digital assets for approximately 8 years, and have had the fortunate opportunity of helping a number of financial institutions design operational controls for product like digital asset custody and many different types of tokenization. So pleasure to be here and share my knowledge with this group. We've talked about it quite a bit throughout the day, which is the power of public blockchains and the capabilities and benefits that they bring, especially with the settlement and execution of exchanging of different types of value, whether it be cash, securities, cryptocurrencies, and so on. And I think we've yet to see the number and the types of digital assets that will operate on a blockchain in the future. Now, one of the challenges that we face, however, is that risk management capabilities have not yet caught up to this new paradigm of technology. And the perfect culmination or example of this was earlier this year, I believe it was January 3rd of this year, joint statement by the FDIC, Fed, and OCC, specifically calling out the risks of public blockchains. And what we can tell you is that since then, we've seen an increased tendency of regulators to not provide approval for public blockchains for solutions and products that do interact with public blockchains. I think the reason this is, and it's kind of a fair criticism, is that the industry has not necessarily caught up with their ability to address the risks that are unique and specific to public blockchains. And so we're going to talk about a little bit of that today. So first thing I want to talk about are what makes blockchains unique and specific and comparatively difficult to manage risk. And we're going to frame that conversation within what is unique about blockchains. And so, I would propose that blockchains have 6 unique attributes that make them different. And we talk about they're built on, they leverage decentralized infrastructure. They have smart contracts. The finality is different than it would be on traditional rails. It's a unique set of skills and talent that hasn't quite developed, that is still developing in the ecosystem. They operate often pseudonymously, and the pace of change is head-spinning. Now, while a lot of these attributes in combination provide some pretty tremendous benefits, right, around reducing the cost of verification and networking, increasing accessibility and transparency across its user base, I think that those are often double-edged swords, and there are some unique and new risks that these attributes introduce, as well as benefits. And so for the purposes of this conversation, I want to focus on 2 of the unique attributes, 2 of the ones that I believe to be the most beneficial, which is decentralized infrastructure and smart contracts. So let's talk about both of those components and how they differ from traditional models. So if I wanted, start with decentralized infrastructure. If I wanted to launch a traditional software product, I would develop the code, I would deploy the code on a server on my mainframe, or maybe I'd deploy it on a server in a cloud instance. And I would either hire a team to manage that infrastructure, or in the event that it was being deployed to a third-party infrastructure, I would have an SLA in place. I would have reviewed the SOC report to determine that they've done everything properly. The problem is that with a blockchain, you cannot do this, right? There is no counterparty from whom you can create a legal agreement or SLA. As an example, I worked for a large technology provider that has had an SLA in place. If the infrastructure they provided for financial institution went down, they were remunerated $100,000 per minute. You cannot, in other words, they manage that infrastructure risk, financial risk, through an SLA with the service provider. You cannot accomplish that, as you can imagine, on a blockchain. That's one example, right? The issue now with smart contracts is organizations often work very hard to protect their code from unapproved access. You're doing quite the opposite on the blockchain. You are taking your code, you're deploying it to a public blockchain, and anyone who wants to in the world can bang away at it for vulnerabilities with impunity. And this goes against a lot of the best practices that we strive towards in more traditional models. And so these are the unique challenges that these components of blockchain provide. So what we need to do is we need to think of, these are new challenges, we need to think of new solutions. And so there are a couple different ways that you can look at mitigating this risk. We look at it as you can create preventative controls, detective controls, and even corrective controls. Now, we're going to be focusing on the detective controls in this conversation. That is not to undermine the importance of preventative, and we are seeing a lot of focus and doing a lot of work in establishing preventative controls, but we feel that one of the areas in which we see the ecosystem potentially lagging and really needing our help is with the detective piece. So why are we focusing on the detective? Why is this particularly challenging? So the one challenge is that that traditional risk management capabilities are often designed to solve and mirror traditional business models and products. And they often operate on data lags and operate during traditional business hours. These are often completely insufficient for many products that run on a public blockchain. The other challenge is they often require consolidation of data from multiple data sources in real time, both on-chain, off-chain, publicly available and proprietary data streams that you need to consolidate in order to make real-time decisions and triage responses. But what I would say is that monitoring should not be viewed just as a response to regulatory requirements. I think that our perspective is this is the future of what sound operations look like in the Web3 era. With that said, if you do this properly, you can unlock access. This can unlock access to public blockchains for regulated institutions and create that regulatory moat that Yusuf mentioned earlier. So with that said, let's go ahead and let's click on the 4 types of monitoring that we see here. And you can certainly go ahead and disagree with our naming lexicon. You know, this is our proposal and how we talk about this with our clients. I have seen different names for some of these, but as a framework, I think it holds true. So we have 4 types of on-chain monitoring. The first is network monitoring. Network monitoring focuses on ensuring the network is processing transactions accurately and in a timely manner and in line with expectations. Sounds simple, but if you think about the miracle that is the public blockchain, the complex interaction between technology, game theory, incentivization, creating a system by which everyone acts as they're supposed to, what's tremendous is this model has been working for a long time, but it is our job to make sure that it continues to work as intended. So we refer to that as network monitoring. Transaction monitoring is monitoring transactions related to a particular asset or set of wallets for some sort of suspicious or incompliant activity and taking appropriate action. Smart contract monitoring is around ensuring that smart contracts are operating as intended, no improper functions or upgrades occur, no unapproved or unintended transactions occur, and there are no exploits or hacks of any kind. So that's smart contract monitoring. Asset monitoring is monitoring how a particular asset is being used in the broader ecosystem. Do we see fluctuations in price movement, large liquidity transfers, et cetera? So asset monitoring being the last piece. Now, what I'll say is that the 4 types of monitoring are not necessarily applicable for every participant. As an example, an institution that offers staking may care deeply about network monitoring, but far, far less about the other 3. An institution that offers a stablecoin or tokenized deposit may care about all 4 deeply, as an example. So it was really understanding which one of these are relevant to you and your product and making sure you're taking the right action in accordance with that. So with that said, let's explore some examples. So you don't have to, don't squint too hard in an attempt to read all of this. I'm going to talk you through what's relevant. But some of the things you have to think through when figuring out what and how do I monitor? So initially we look at this as a 4-step process. So first you need to determine what data needs to be monitored. And often it's not one source, but it's actually the combination of multiple. I'll give the most basic example of this that I can think of is if you're issuing a stablecoin, you need to capture on-chain data of token supply. You need to capture off-chain data of reserve supply and make sure that there's parity, right? And obviously this is intuitive, but just to make the point that you're often bringing multiple sources of data together. And what are those sources? That's the first thing. That's number 1. Number 2, you have to determine how that data can be monitored. When you're monitoring for a specific action, activity, or trigger on chain, often that doesn't come as easily as you would like, and you need some sort of bespoke tool or software in order to do that. So determining what those valid data sources are and how you can monitor them is step 2. Step 3 is establishing thresholds or triggers of what is acceptable and what requires some sort of incident response. And then once you've established what those triggers are, the last piece, and this is the piece that we're helping our clients develop in this space, is actually developing the required monitoring infrastructure and software. You can leverage out external tooling. You can leverage external service providers, but ultimately you'll be needing to put all of these together into a homegrown program that's going to be able to operate that data in a way that mitigates risk sufficient to your thresholds. So that's step 4. Now I'll add a step 5, which is not so much monitoring as it is once you've determined a potentially disruptive event, you need to establish incident response. And so where possible, you need to be looking to automate those responses. That response could be as simple as a notification to an appropriate party to escalate to that event to a manual review. But in some more severe instances, you may want to automate a response of blacklisting a particular wallet. You may want to automate the response in the most catastrophic of scenarios of pausing the entire token contract, in essence, shutting down your product temporarily until you're able to figure out what's going wrong or remediate any issue that you've discovered, right? And the extent to which you can automate those responses, and this is not simple, it requires net new software and potentially infrastructure. This is how you're going to maximize your ability to address these risks and mitigate them. In order to do that, and what the right side of this slide represents is you're going to need net new tooling. And so I just want to give a few examples of tooling that we use or that we've seen folks use to help monitor and address these risks. So one external tool, an example is a software tool known as Forta, and Forta provides monitoring bots, so monitoring software that runs on decentralized infrastructure that watches and monitors for one specific data stream or trigger. And this can be, it monitors for new minting on a stablecoin contract. It monitors for deposits into a bridging contract, right? They're very, very specific and focused pieces of software that monitor for a single activity and run on decentralized infrastructure, creating resilience, right? So that's one tool that you could use in order to monitor for certain on-chain events. Forta may not offer all of the events that you require, and so you may need to develop these types of monitoring bots yourself. A second external tool is, as an example, the Masari Governor product. That's going to allow you to look out for governance actions on DeFi protocols and blockchains so that you can sufficiently anticipate votes on upgrade, hard forks, changes in functionality, et cetera, which would give you the opportunity to ensure that none of these functionality adjustments are breaking for your product. And then the last is really ultimately the work that we all need to do, which is each organization is going to need to build an internal tool. An example of this would be a compliance engine, one that maybe ingests on-chain data, identifies transactions that do not meet compliance requirements, and then triaging or responding to those types of transactions. And again, the ability to do that requires you to aggregate data of many types, including off-chain policies and on-chain activity, matching those if possible in real time, and automating the triage response should a trigger be identified. So I think in order to by implementing these and by demonstrating, equally importantly to regulators, that you have the capability to manage these risks, this is going to allow you to break into new. This is going to allow you to launch products that you would not have otherwise received approval for. This is going to allow you to develop that regulatory moat that is, as many of us are experiencing, a hard one to build, and in the future, set your organization up for what is ultimately the future of risk management in a post-Web3 world. So with the last few minutes I have left, I'm going to walk through just one or two very specific and acute examples of how this might work. These are not particularly complex, nor are they close to comprehensive, but it will start hopefully making this resonate as to how this comes together in a risk management program for an organization. So first thing we're going to look at is network monitoring. So if you look at how the network changes, how a given network changes over time, Ethereum being the perfect example of this, right? First step is that a governance proposal is put forward for updating the network. That proposal is reviewed and voted on in accordance with the governance process. And this is something that often occurs offline, especially the proposal piece, the vote sometimes on-chain. But ultimately, you need to be made aware that a governance proposal does exist. You need to be aware that it is gaining traction, and you need the opportunity to review it so that you can understand if any of these proposed changes will be breaking to your solution. If it's passed, you need to understand what type of adoption it is gaining with the appropriate nodes, and you need to understand if this is ultimately going to be a contentious or uncontentious fork, resulting in potential up to multiple assets, right? And although we've seen convergence around the ability for the Ethereum network, particularly to upgrade without this happening, I think it's one of the biggest strengths of the Ethereum network. We cannot take that for granted, that these upgrades are non-contentious moving forward. So how do we handle this? Well, first monitoring criteria. First, we need to be able to detect the new proposal. Second, and that's often an off-chain event. And so what are we going to do? Maybe we'll use a Masari governor or some sort of off-chain data aggregation service provider or news provider. Now we need to detect the network upgrade. This is going to be, for this, we're required to run node infrastructure that's going to look at the network upgrade and receive data inputs as to the level of adoption across the nodes on the network. And then third, we need to be looking out for any fork that may occur. If the fork occurs, and then fourth and finally is, once that you've detected all three of these things, you need a policy engine that indicates, if this occurs, take this action. If that occurs, take that action. And as best you can, you need to be looking to automate those triage responses. So this is one example of how we're bringing together external data sources like a news and governance data aggregator with on-chain node infrastructure that's watching for multiple different things. We're putting these all together in order to create a view of what is happening to the network, and then we have policies put in place so that we can rapidly react to whatever outputs come from those three data sources. That's one example. I think we have time for one more example, which is a bridge contract. So in this scenario, your solution leverages a bridge between two protocols. And let's use the example of the Ethereum and the Polygon proof of stake. You may run this bridge, you may not. I don't think it matters. I think that really the mindset that we need to be taking is it is up to us to take ownership over our assets, regardless of how they're being used. And so one of the challenges you're going to face is just making sure that if your assets are being bridged, they're being bridged properly. And so what does that process look like? Well, initially, the asset is deposited into the bridge contract of one blockchain. The oracle on the second blockchain picks up that deposit and instructs a mint on the second blockchain. That blockchain smart contract mints a new wrapped asset, and those wrapped assets or tokens are sent and transferred to the designated address. So those are the 4 steps that occur for a bridging of a token. Now, what do we need to look out for? Well, first, we need some sort of monitoring software to see when our asset has, and in what amount our asset has been deposited into a bridge contract. It needs that data. Second, it needs to see how many wrapped tokens, corresponding wrapped tokens, are being minted on the second blockchains, on the second blockchain. And third, we need to make sure that those happen timely, and we need to make sure that there's parity in the amounts, right? If there is a unexplained delay in the minting of new tokens, this may represent an error and action may be required. If you are depositing 10, but they're minting 11, obviously this is a non-trivial issue. And so, what do the triage responses look like? In some cases, it may be a notification to customers in order to warn them of this problem. In some more extreme cases, it may simply be to blacklist that bridge contract, in essence, preventing your users from using that bridge if you know that it is faulty. So these are the types of ways that we can use net new software, net new infrastructure to gather data from multiple sources, combine them to make a decision, and execute a triaging response ultimately to mitigate risk, gain regulatory approval, create your regulatory moat, and operate in a new Web3 world. So that's what I wanted to discuss with you today, and I appreciate your time.
Graham, thank you very much. I definitely believe that this monitoring of blockchain activity will definitely be a part of how we manage risk in the future, especially when you integrate AI into these capabilities. With that, I'd like to wrap up the session and transfer the speaking part to Leek, and who's going to talk about tokenization in financial services. Thank you very much.
Thank you, Chen. Hi, everyone. My name is Leek Shabir. I'm a director based out of EY. Many thanks for joining the session, and Chen, thanks again for talking through and introducing us. We'll be talking about tokenization, the future of financial services. It's a full-packed agenda for a number of things that we'll be talking about, the end-to-end state. And with us, we'll have quite a number of speakers. So I'll not waste any more time because I'm conscious you want to speak to and hear the people who will be presenting. So we've got first up Boris from Copper. He's the CCO, not Chief Compliance Officer. It's the Chief Commercial Officer, and he's also a co-founder. So Boris, over to you.
Thank you very much. Hello, everybody. I'm looking at screen, so I don't know exactly who's there. I'm just waiting for the presentation to come up. Yeah, pleasure to be here today. Maybe to start off, there we go. Maybe to start off, a little bit of an introduction, who doesn't know what or who Copper is. We started in 2018 to solve for the custodial problem in the space, specifically on an institutional level. From there on, the journey kind of went on in order to solve for various problems that were in existence, namely in and around collateral management and the settlement infrastructure that was lacking. I think in and around the collateral management and settlement piece, one of the core things that maybe some of you who are in the space have been hearing about is a product called Clearloop, which is an off-exchange settlement solution. So if you remember the wonderful time where Sam Bankman-Fried kind of screwed up, I'm just saying those words anyway, so I apologize, that wouldn't have happened because at no point in time you would have assets sitting on the exchange. That is all in segregated third-party custody, and you settle post-trade within that infrastructure. About Copper here briefly, 300 is actually 400 plus clients. That slide is a little bit out of date. We've got about 300 people globally with global locations and integrated into various liquidity providers, not only on the centralized side, also ECNs and connectivity to DeFi. However, this is not necessarily about Copper here. This is more in and about what the industry is and where we are. Tumultuous times last year. I think everybody is in agreement and knows that. So we need to kind of take a step back and see where we are in terms of the adoption curve. This is a new technology, and I, throughout this presentation, would like to kind of step away slightly from the topic of crypto, because as we say, it is about digital assets and the tokenization of actually interesting financial instruments that are about with sufficient liquidity. We're going to talk about that as well in far more detail. But first and foremost, we need to just realize and accept the fact that this is a new technology that solves a lot of problems. It might be very scary as well, but since its existence since 2009, or at least the white paper, there is a lot of stuff that happened, innovation on a continuous basis that actually has an applicable approach also in traditional financial services. You can see the numbers here on the screen, a lot of different innovations that basically, in terms of an adoption curve and how they actually look, digital assets is still very in its nascent state. The idea of everything working in a linear fashion, that everything is a smooth ride, is absolutely not the case. We had several winters already, and there will be more. But where we are right now, which for us as a business, and I think for the industry as a whole, is a very positive feel, is that actually is the time to build and actually rethink of how we can actually drive this forward. Maybe a quick glance into the topic that we actually all want to talk about, and this is traditional financial markets, which is a very, very complex topic, but we can break it down in rather simple ways. Here, first and foremost, assets that you see that are available globally to be trading. At the end of the day, it comes down to buyers and sellers, and then a whole level of infrastructure and intermediaries that, if you actually implement the technology correctly, are not necessarily needed. Digital assets, as you know, in terms of market cap, are in the region of like 1 to 2 billion. That's where it's been hovering around, all the way to the other side, global debt, which is also going through quite a tumultuous times right now with interest rates going all over the place. Global stocks and et cetera. You basically see the numbers here on the screen. It's a huge amount of money and ultimately wealth that needs to be managed and is currently managed in an infrastructure that is, in my opinion and our opinion at Copper, extremely archaic. Having said this, let's look into what's actually happening on a day-to-day basis. And maybe some of you that call up your banker and say, buy me 10,000 Apple shares, you don't actually care or know what's actually happening once somebody pushes a button on the 4th floor. What I can tell you, being in that industry for 15 years before starting Copper, is that there are a lot of people running around with Excel sheets, trying to sync up databases, chasing MT500 messages for days in order to try and settle a trade that happened 2 days before. Surely in 2023 we can do better. And ultimately what you have is also the necessity, or you have to deal with several problems. As you can see here listed, counterparty risk, one of the bigger ones. There are a load of various intermediaries, and I'm going to break this down further later on, where we're going to talk about actual certain financial prime services that you can, or funds, which are the ones that we mainly service, access on a daily basis, and what that actually entails, where nobody really thinks about, but all of that stuff is priced in. At the end of the day, where we're going to get to by the end of this presentation is that we should result in a world that ultimately is faster, better, and cheaper. And we're going to break this down in a second. Costly and inefficient, no wonder. There are thousands of people on Wall Street, thousands of people in London that need to be paid, running around trying to settle trades and try to sync up databases, do reconciliation. All of that is very also capital inefficient, because you have a lot of trapped liquidity that ultimately could be used otherwise. So those are like some of the core problems. There is a kilometer or more, but at the end of the day, this is the infrastructure that we have now. When you just think about, I want to buy something and somebody wants to sell something, there are a lot of wheels in motion in order to make sure that that transaction actually can be seen as final. Now, looking at blockchain in its pure technological form, that layer offers enormous benefits. And I'm trying to step away from going into too much detail, but at the end of the day, what you've seen on the slide before can be broken down into those 4 pillars. Buyers and sellers will exist going forward. However, the middle and back office layer, when it comes to clearing, when it comes to custody, when it comes to settlement, is something that can be actually smart contract based. Now, I'm not one of those DeFi maxis that will tell you in 2 years' time, you will sit in your underwear on a Sunday morning and draw a new mortgage via some smart contract somewhere. There is a huge value chain that basically needs to pull in on the same string in order to make sure that something like this is possible. Eventually it will, but there is a lot of work that needs to be done. Now, when it comes to trading venues, smart contract based, and this is also where we talk about operational excellence, you look at NASDAQ, which has about 5,000 people employed, and there is about 5 billion of spot volume going through. At the same time, Uniswap, up until recently, had 35 engineers, and there is 1.5 billion of spot volume going through. So it is possible to be done. It now needs to be translated away from, White Sox, very much crypto maxi people, into something that is regulatable and understandable. The next point is the tokenization of assets. Actually, in its pure technological form, extremely easy. And what I mean there, you can tokenize anything in 15 minutes on an ERC standard. The difficult part to figure out is ultimately liquidity and interoperability. On that front, of course, debt, equities, FX, what we've seen so far, CBDCs is a big topic. But you already have players in the market, such as Circle, that basically do that on a day-to-day basis. Then you've got the blockchain layer. And the blockchain layer is an absolutely crucial one when it comes to understanding of what this technology can actually do. Middle and back office here needs to be highlighted, mainly because of what I said before. You don't need any human interaction anymore in order to figure out where money is. All of it is transparently visible on the blockchain, ultimately also a godsend for the regulator once they figure out of how to read a node. So we are actually at a point now where you can see all the parts working together, and I'm going to go into more detail in order to show how the whole end-to-end life cycle of a transaction could look like in its tokenized format. We at Copper have been thinking about this for a long time. The infrastructure that we have built in and around pure custody, the settlement, and also anything in terms of like, you know, the funky DeFi stuff and accessibility thereof via our infrastructure is something that is in existence. There is still a lot of work to be done, but I think specifically in and around prime services, we are on a very, very good road in order to make sure that we will be able to offer something like this in the near future. But now let's look at the benefits, because, and I'm sure you can read this on the screen yourself, but there are a couple that I would like to highlight. Greater capital efficiency. Trapped liquidity is a big, big topic, because if assets are basically trapped due to settlement cycles, it's something that is unnecessary. Reconciliation takes a lot of time. You have basically the ability to settle and trade instantaneously, whereas we have to say in the traditional financial world right now, pre-trade is extremely efficient. We're talking about microseconds. People are putting glass fibers next to the exchanges in order to be trading faster. This is all working very well. But as soon as you basically hit the F1, F2 button to buy or sell, that's where all the hocus pocus starts of it being unnecessarily slow. So greater capital efficiency is definitely one of the core things. Right next to it, of course, lower cost. If you don't have to pay all those people in order to run around with Excel sheets trying to sync up databases, you actually have a very, very fair price that ultimately can be given to the street, which is a very, very broad topic from the top down, but ultimately very much achievable. Something that we have been experimenting at Copper ourselves for quite a number of time now. And like I said earlier, I think we're close to be able to watch that space towards the end of the year. Reduction of counterparty risk, coming back to that very first screen that you've seen with all the intermediaries that need to be paid, and those are institutions that are running their own ledgers. That is a risk that needs to be managed. We see right now, you know, what's happening in the US. The banking sector doesn't look very solid right now, to put it mildly. Nobody would have thought that bank stocks can be as volatile, even more volatile than crypto. Would you believe it? There are a lot of voices, I think, that are currently kind of reconsidering of what has been said around this space and the application thereof. Codify compliance, anything in and around, of course, any regulatory financial services needs to have the relevant compliance in place. Those businesses exist already. Coming back to what I mean with compliance, also here from a regulatory perspective, there is no need anymore to send 20,000 SaaS reports on a daily basis that nobody actually reads. If you are able, in order to understand of what the node does and everything that happens within, you have full transparency in a very much fully compliant KYC AML fashion. There are a lot of suppliers out there, and you will see quite a lot of further advancements in that space. Transparency and ownership and immutability of records. I think we don't need to talk about this too much. Everybody on this call will understand what blockchain actually does by now, but we're talking about the use cases here. Optionality to create new types of assets. Very, very an interesting topic further down the road, but at the end of the day, you will be able to add certain parameters into any sort of structured product that will allow you to create different yield curves. Very, very interesting, but something for the future. And then, of course, democratized assets and automated management of life cycle events, all of that kind of stuff you basically see on the screen. So quite a lot of benefits, big topics that have been thought about by the industry for a long time. And ultimately now we need to figure out of how to translate this and build the bridge between the traditional, a little bit, if I may say so, archaic system that we currently work in. Having said all the above, I think what I try to do here is, what we try to show you here is a little bit of a breakdown of something that actually would be quite simple, especially repo trades. I think that's pretty straightforward. Everybody knows what a repo stands for and what the core components are. On the one side, of course, it is a spot transaction. On the other side, it's a forward contract. And then thirdly, you have margin and collateral management that needs to be done. Now, if you look at that from a buyer and seller perspective, being able to do this within a smart contract, it should be quite simple. However, if you actually look at the transaction flow going step by step from a lender to a dealer to a borrower, this is becoming very complex very quickly, which also then equates to quite some high prices. You need to pay banks, you need to pay sub-custodians because you most likely are not dealing directly with the State Streets and Bonies of this world. You might have a sub-custody solution or sub-custodian that you need to deal with, like cassis, so that needs to kind of figure out in terms of like data and reconciliation. Clearing counterparties, central securities depositories, and all sorts. The list goes on. However, every single red dot here, and I mentioned this earlier, represents a cost. And ultimately, this cost can be taken away in a much more efficient way, which makes it much more appealing to the street, much more a fairer price, but mainly faster and cheaper. Now, a DLT repo trade would look like this. Let me just go back so it's very clear. This is what the repo trade looks like right now in a very simplified format. But this is literally what a repo trade would look like on a DLT-based smart contract. Smart contracts are a godsend gift if implemented correctly, audited correctly, and everything in and around it in terms of reporting, but all of that is doable. You still need the custodial layer because assets need to sit somewhere, and ultimately you have the lender and borrower that can interact within a smart contract in a very, very efficient way. The ultimate benefits here are atomic settlement, of course, which is something that is visible and doable throughout the whole space. Transparent marketplace, again here, the ability to basically see at any point in time exactly of what's going on. You could go even as far as fractionalization, which allows for some more precise collateral management, because sometimes it's very hard to know within an, I think there was, I'm not going to name the bank, but they were still writing loans on the basis of the thought that the person has private jets which already have been sold. Actually, one of them crashed. So they were still writing loans because databases weren't synced up, and actually nobody knew within the bank that this plane doesn't exist anymore. So stuff like this is a major issue, and in and around DLT smart contracts not a problem anymore. And one of the core points here is interoperability. Now, that word is a big one because at the end of the day, if we look about tokenization in its isolation, we have seen a very, very classic curve of innovation. Up until 2021, I'm sure some of you remember, NFTs was a big, big word. You had people running around the streets selling monkeys on a sticker for $500,000, and people were willing to pay that. Ultimately, the NFT in its purest format is actually very, very useful if implemented correctly. Now, talking about the tokenization thereof, the idea then comes in terms of where can I inject liquidity? And that is a very, very difficult thing to figure out, which is one of the reasons of why tokenization projects that you've seen so far mainly went down the road of trying to figure out of how to tokenize a building or how to tokenize art. It's very hard to inject liquidity into this. The question then automatically arises, why is it done like that? And why don't we take assets that are very liquid in its traditional state right now, which are the ones that you've seen at the beginning in terms of debt, equities, and so on and so on. Because it's very difficult. And you need an infrastructural layer that can support this, which is something that is in the works. I kind of alluded to it before. I wish that I could say more, but I only have 2 more minutes and 50 seconds left. We would need a session of about 5 hours in order to go into detail there, but watch the space over the course of, and the rest of the year. I want to leave you with this because at the end of the day, custody, I think, is, like I said, a crucial part. Assets need to be sitting somewhere securely, and there are various ways that you can do this in the space. I'm not going to bore you too much. You have hot wallets, of course, which in many ways is a very stupid idea because it's very much prone to attack. You've got software wallets as well. But I think the most prevalent ones are HSMs, which are hardware security modules. Easier to understand because you just think about a box that is sitting somewhere in a cellar and somebody walks there and signs transactions. It's a little bit more complicated or complex than this, and actually much more interoperable by now. So those are solutions, as well as, of course, key sharding, the likes of Shamir secret sharing. I think is one of the most prevalent ones. But at the end of the day, what it also comes down to is that when you talk about key sharding, you talk about a private key having been in existence in its entirety at some point. Secure MPC, I think this is the way forward. We're also an MPC custodian. The important part here is a full private key has never been in existence in its entirety. You create key shards separately, and ultimately you don't have a central point of risk of failure. Are you already stepping in?
Please, no,
okay,
please continue.
I think I'm still good.
Yes.
But it's actually, I'm more or less done. We ultimately talked about it there. Now, the beauty about MPC as well, that you have the ability to have various signing quorums, 2 out of 3. So it's basically M out of N. Operationally, it becomes quite complex if you go beyond 2 out of 3, to be honest. So we decided for a 2 out of 3 signing quorum. At the end of the day, this can happen in an offline environment. So you don't really have to worry about, just like in the real world right now, if you're buying Apple shares, you do not care if they're currently, or you don't think about if they currently sit with BNY, State Street, JP Morgan or Citi. You just know that there is a custodial layer that takes care of that piece of a whole trade and ultimately allows you to do your business on a day-to-day basis. With that tokenization overview, I think we talked about this slightly. There are various players out there. I promise I'm going to be in time. Some of those names you know, but at the end of the day, what they're doing is paving the way right now in order to make sure that a world like I very briefly on a high level outlined is actually possible. Here as well, again, the custodial layer being core plugs into every single piece that we have built so far. And yeah, with that, I think I'm out in 5 seconds. I promised I was on time.
No, you're absolutely fine on time. But look, I think you talked great about the custody, how you've broken it down for the market about from a tokenization perspective. But before we leave and let you go, final thoughts about what the market can expect from copper when it comes to tokenization and the future state.
What you can expect is that that we will be able to figure out, and I can say that we kind of figured it out already, at least in mathematical expectation, to inject or to have the interoperable layer between market participants on an infrastructural layer available. That will happen towards the end of the year, beginning of next. But yeah, that's what people should look out for. At the end of the day, we service institutional clients only. We build services and infrastructure for them, which means we solve for certain prime services that a hedge fund will take on a day-to-day basis. And it's a heavy lift, however, very much doable because of the great innovation that has happened in the space over the course of the last 15 years.
Excellent. With that, thank you very much, Boris, and for coming in our office. Everyone, I think this was a great session, but we're now going to move forward. I would love to introduce Marieke from Near Protocol. She's the CEO. I'm conscious, Marieke, thank you very much for joining us. Saddened by the fact that you're not here in London with us, but absolutely fine, but equally quite happy that you could join us in Zoom. With that being said, I hand it over to you to talk us about Near Protocol and how you are working from a tokenization and future state perspective.
Yes, hello, really great to be here and remote. So I'm the CEO of the Near Foundation, which looks after the Near Protocol. And the role of the Near Foundation is actually to help foster the growth of the Near ecosystem, which is therefore centered around the Near Protocol. Can I just check on the slides? I don't see them coming up. Do you guys have the slides? Yes, perfect. Okay, excellent. So by way of short intro, so I've been in crypto since 2015. I joined in actually working for Circle, which enables, amongst other many things, actually the stablecoin, which is USDC. What I want to do in this talk today is a couple of things, is actually tell you a little bit more about actually the Near story, where we came from and what we're doing and how we think about things. Tell you about actually within that ecosystem, what is the role of crypto foundations. Many of the crypto ecosystems are built around crypto foundations, so I want to give insights into that. And last but not least, I want to talk about tokenization of everything and bring to life some of the concrete examples that actually we see happen. And core to our mission is actually thinking through how can we get to 1 billion users into this world of Web3 and the open web. And so that's the thought and the process that I want to drive with you guys. So if we go into what is Near, actually a little bit of story. So Near started in 2018, first actually as an AI project, and the name Near is actually because singularity is near. And so the idea was first for Alex and Ilya, the founders of Near, to think through, well, what if we had AI that could enable us to create any program anywhere in the world, and therefore to scale things massively, which we probably remind and give a hint into what we're seeing in today's world. But to do that, to build that first project, actually Alex and Ilya had a lot of people and builders that were all around the world and that were helping them develop the project, and they needed to actually pay those contractors and those freelancers, and thought, okay, we've heard about blockchain, so we're going to use blockchain as a solution to basically do our payments. And guess what? They realized very quickly that it was very, very slow, that it was very expensive, that actually the usability of it was not working. And in the thought process, the idea was that ultimately blockchain was going to be the thing that was going to be needed to do those microtransactions and to help the world move forward as we were going to move into this AI and this possibility to have anyone or any machine build anything. So that's a little bit of the story, which I think is extremely relevant in how we see the world and how we think of things today. So moving from this first pass into AI, the team actually moved forward and changed and said, okay, what is actually needed is having a better, faster layer one and the ability to actually have something that is extremely fast and extremely cheap and extremely usable. And so that's been the premises actually of the story. To give you an idea of numbers of where we're at today, so on Near, we have over 24 million accounts. We have over 1 million monthly active accounts. There is over 1,100 projects that are active and that have been built on Near as a layer one. We have over 300 million transactions, and there has been an amount of capital that is over 550 million external capital that's been brought into the actually ecosystem to help the founders who are deciding to build on Near come through. So what are the beliefs if you want to get to 1 billion users? Number one is actually that it's actually extremely important to focus on simplicity and usability. So simplicity for end users, simplicity for developers. It's also this paradigm shift of making sure that while being very simple and scalable, things can be extremely secure. And not only that, but also how do we actually have things that are done in a sustainable fashion? This is something that we see more and more today. We work a lot with a lot of enterprises, and we see a demand for being able actually not to respond to just being very simple and very usable, but also actually being extremely sustainable, friendly, and scalable. And so the layer one, which is the core fundamental of Near as a blockchain operating system as it exists today, actually fits all those different paradigms. Now, in our evolution, and this is something that we are seeing more and more, and our reflection of 2022 was the following. In the 2022 landscape of blockchains, you have something like over 150 different layer ones, and you have a bunch of different layer twos. And actually, you have many different components and infrastructure. And you hear a lot of how can things be interoperable? And what is actually needed to give users the best possible experience? And so what we realized that we have a lot of the building blocks for creating what is the first what we call blockchain operating system, which in a nutshell means that actually, if you are an enterprise, you can think today of choosing the level of decentralization that you actually want to fulfill the user case and the case that you want. So this is live today. If you go on near.org and you actually start onboarding yourself, what you can see is actually developers creating new widgets and basically enabling others to come through. There is ways to authenticate users that are actually faster than what you could see in Web 2 today. And as an enterprise, you can basically pick and choose and create the modularity of what is needed. So in short, where I'm today and in the story of what I've been saying today is actually this evolution of moving from there is a need, how actually will AI transform the world? But to do that, you actually need to have the fundamental, which is a layer one. And actually just thinking in terms of layer one means that things are way too fragmented. And therefore, to get into this mass adoption, what is needed is the next stage and the next elevation, which we call blockchain operating system. Within that, the easiest way to think about what is a blockchain operating system is to think of different layers and therefore a stack of things that are needed. So you have not only like the fundamental blockchain protocols. So for example, that could be Ethereum, that could be Near, that could be many other. Then you actually have the core platform, and then you have this layer of discoverability. One of the things that actually is very broken today in Web3 is like, how do you discover all those projects that exist without having to necessarily spend many hours going, for example, on Twitter. So that's what the blockchain operating system in a box is like the packaging of all those different solutions. We have a couple of different apps that exist and that are continuously being built on that. I'll just call your attention on what is on the bottom right-hand side, which is called Sweatcoin. It's an app that has over 150 million users actually in the world. And the goal of that app is actually to say, well, if you walk, you get tokens. And with those tokens, what can you actually do to be rewarded to keep being fitter? So within that, what's the role of a foundation? And I mentioned that, but decentralization is at the core and the heart of how most crypto ecosystem evolve. Near from the start has been very true to thinking through decentralization and to having governance and funding and different things being owned by different parties. Within that, the foundation exists to, in particular, help kickstart the growth of an autonomous and decentralized ecosystem. So our role as a foundation is to help, share what is actually the vision of Near, what is the technology that is available, but also like what is the support that, the many projects and the many developers that are coming to build on Near need. And then our third pillar is also to think through how do we enable decentralized governance? How do we think through actually what regulation is and where regulation is going? It is a bear market, and I'm sure that's been discussed over and over throughout the day. Now, the key fundamental pillars for moving in a bear market are actually threefold. One, if the technology that's been built is not solid, not a good sign. In the Near ecosystem, the technology has always been like a strength of ours, but also you need to have the pillars to be able to move to this mass adoption, which is actually extremely important for the next stage. So our convictions in this bear market are that number one, it's actually all about users. It is about usability. It is about real use cases, whether they are actually in TradFi, which is leveraging blockchain, or whether they are actually with enterprises who are, showcasing new use cases such as, for example, loyalty and so on and so forth. Our second conviction is that actually it's all about technology. So having fundamental technology that can scale, that is actually responding to the many, many demands that we see. We see that as being extremely important and fundamental in this world of like tokenization of everything. And the last point is, the reality is that, yes, Web3 or the open web, however we want to call that, has been growing a lot. And there is, many hundreds of millions of participants in that. But we are still very far as an overall industry from this mass adoption. And the reality is that that will come because there is a pathway from Web2 to Web3. And therefore, how do we accelerate the use cases from bigger enterprises coming onto blockchain? So those are the convictions that we have, which we think actually echo very well the thinking through a tokenization of everything world. Now, tokenization of everything, what is it that we're seeing? And so I think here sharing a little bit of our market experience. 2022 has been a quite traumatic market, in particular for anything that's more related to crypto trading and all that infrastructure. However, the appetite from enterprises to figure out what it means to be involved in the metaverse, what it means to have a Web3 strategy, we see that continuously growing. And one observation that we've made and that we see is that most, FTSE 500 or most actually companies have, a small team sometimes it's called like the metaverse team, sometimes it's called the Web3 team, sometimes it's called the crypto team. It depends the name that is being taken, but there is always like on the side a lab or a small team that is actually trying to figure out what does it mean for the business model and what does it mean for the future. Two things. One, that's giving us a strong indication that actually there is a realization that most of the technology has made humongous progress, and that's indeed something that we see. And number two, there is a realization that business models can be reinvented, and therefore revenue can be grown out of this new technology. And so with that, a couple of use cases that are, so here, not just specific to NEAR in particular, but, use cases that we see happen more and more. We see a digitization, for example, of different goods. That's something that we see happen more and more. We see a ton of retail brands actually coming through and saying, how can I engage and have my users and my owners actually own a part of a team, a part of an asset? And so we do see that a lot. Rewards program, loyalty is a very big topic. And we do see actually across the industry, again, how to reinvent and have loyalty programs that actually are much more transferable from one brand to the other, and loyalty programs where the owner and the user is actually really owning whatever token they've actually got. Ticketing is also an area in which we see a lot of appetite. And I think that's going to be a fascinating area to think through and to see how it evolves. But again, sports, in particular in the sports vertical, thinking through how ticketing can change the relationship with fans, how it can eliminate fraud, and how actually it can also reduce the fees of what's happening. So there is different projects on that front. And last but not least, but of course, anything that's related to payment rails, faster transactions are of course things that are also within the Web3 space, and therefore in that thinking of tokenization of everything, things that are therefore very real. So in terms of how we think and what we see happening on NEAR, the slide before was more like industry specific. A lot of the things that we see are around retention and engagement, and the possibility also to leverage Web3 to have like new venues for monetization. So for example, on retention and engagement, there is the possibility with like NFT are not just like a JPEG. They're basically a card in which we can put more assets, more experiences, and so that possibility to personalize more customer experience is definitely there. The possibility to actually engage on governance. So for example, bringing your fans and having them vote on what they want to do on the team is also use cases that we actually see more and more. The possibility to do something to earn, and therefore flipping models and having, whether it's a community that you want to be physically active or a community that you want to actually engage to do activities or to learn something are definitely things. Now, the last part on that side that we also see is definitely around achievements, but also reputation scoring, and how can you leverage the technology to therefore showcase and you showcase the progress you've been making, for example, within an environment. On the right hand side are a couple of things around how we see brands and companies actually evolve and think through what are the monetization paths, and actually how can you make a new business line with some of the digital goods or loyalty as an asset that are coming through. I think this is quite specific to the focus we have also on like usability, but I think it's also a real showcase into what it will mean to get the next billion users actually coming on chain. So the last, I have 3 more slides, and those are just like snippets again of examples that we see, but also to give an idea probably to the audience of as you think through, what does tokenization of everything mean? That it's not just, traditional financial assets, but that there is now today like platforms and things that exist and therefore on which you can lean. So for example, Recur is a white label platform for NFT for brands. So it's completely turnkey. As a brand, you can decide to say, I'd like to have a collection, which is going to be how I'm going to engage my next for my next collection on a certain, maybe a movie, or maybe actually something like an engagement campaign. And you basically, with like very few development needed, you can start having a campaign and therefore think through different ways and different engagement models for your community. SailGP is reinventing, the competition of sailing. It's Formula One race, but on water, and therefore very sustainable. We've been working with SailGP for a little bit over a year, and on that front, a couple of different things that we think that have been actually groundbreaking in the sports industry. One is actually the creation of a DAO that owns a team. So for the first time, you have, a team, a full professional team that is actually owned by a community of people who can actually vote on who they want to have on the team and what they want the team actually to do. The challenge here was not technical. The challenge here was more actually on the legal side of things, like what is the framework and how can you actually leverage that. Other concrete applications that we're seeing with that league are around ticketing and around loyalty and fan-based engagement on that front. So I think this one is also a really good example of like, a real sports league that is in the world out there and that is actually leveraging the technology to think through not just like fan engagement, but also have to have participation of the community. And the last one is also on, loyalty experience and what we see on that front. So here again, it's in a way, it's a piece of infrastructure, but I think it's actually really important to have those infrastructure pieces, but loyalty solutions that help also brands have like an end-to-end program management, right? So in a way, what we're seeing is actually, if you think of marketing and engagement and what does it mean to have like that new fan engagement to the next level, Web3 becomes this real potential solution. And that's it. I'm done with the slides. Thank you very much.
Thank you, Mariaki, for your presentation. Very much on time, so I highly appreciate the fact that you've done it very well. But with that said, I think we wanted to just ask you one question before we could let you go, which was a nice question, just because we want to make sure people can appreciate NEAR protocol much more. So one question we have is about how diverse NEAR node network is. And based on your experience, are there any significant barriers to entry for setting up a node and being part of the consensus activity?
Yeah, great question. So the beauty of NEAR is that actually it scales as it grows. And so today we have hundreds of validators. And the idea is that also like the number of NEAR that you need to stake to be a validator is constantly decreasing. And to set up becoming a validator is actually extremely easy. You don't need any specific material or you don't need to have to buy any specific machine. So the barrier to entry to becoming a validator on the financial side of what you need are actually lowering up every day as we scale. And then the barrier to entry in terms of technical setup are themselves already very, very low. So I would say even on that front, thank you for asking that very nice question, but that's one of the things that makes NEAR actually very usable and scalable.
Brilliant. Well, thank you very much, Mariaki, for joining and your presentation.
Thank you.
Thank you. So next up, we have Finality. We have Stefan from Finality, who is a director. He's obviously done quite interesting things, and I'll let him introduce himself. But over to Stefan in terms of presenting what Finality has been doing in the tokenization space. So over to you.
Thank you, Laik, for having me. Quite exciting topic. And I'm quite excited to talk about the solution the company Finality I work for is I'm working on. So but I'm also quite excited because I think Finality is an important piece of the overall tokenized market puzzle. I'll come to that in a second. So, but first of all, I'm Stefan. I'm working at Finality since a year. So I'm covering various things from fundraising to central bank engagement and also business development. And before that, I was many years at Deutsche Bank looking after wholesale payments. So Finality, the company, has started around 2015 as a research project led by a handful of banks, way before terms like CBDC or stablecoins were mainstream. And those banks had that vision, or they were foreseeing that once this tokenized asset market takes off now, there needs to be a means of payments now, and not the old rails. Now you want to preserve all the benefits of smart contracts, like what Boris mentioned now in the earlier session. You need basically a blockchain-based means of payments. And once they were confident that this can be done with the current regulation and also now guided by the leading central banks, Finality has been founded in 2019. Currently, we have 80 employees across a few countries and are supported by around 18 global banks and financial market infrastructures. So in the next 12 minutes, I will quickly look at the product, the solution we are working on. then at the key use case on how can Finality or how will Finality support the overall tokenized market movement, if I can call that way. And third point, let's look under the hood how the Finality payment system actually works. So first point, the products. So let me quickly move forward here. The products, before I start with the product, I should say that now these banks in the research project I mentioned earlier, they had 3 criteria in mind, or 3 requirements which that solution needs to meet. One is it needs to have a similar credit quality than central bank money, because the banks, we're talking about wholesale here, the banks don't want to introduce, let's say, additional counterparty or settlement risk. Second, there needs to be a finality of payments, so that's where the name comes from. So basically, once a payment has been made, there are no legal or technical means to reverse that payment. And third, it needs to be, a very complicated word for me, interoperable with different blockchains, because similar to what Boris mentioned earlier, those banks already knew that now there will be not one, let's say, blockchain hosting all tokenized assets. There will be many of those chains. And that solution, that cash leg, needs to, of course, be able to communicate with all these different chains. So with these 3 requirements in mind, a quick overview on the product itself. So basically, it is I would say, blockchain-powered, fully regulated payment system in one jurisdiction. Very important, because that was, let's say, a guidance from the central banks. Now, it will be very complicated to create one, let's say, cash leg, one blockchain across multiple jurisdictions. Now, it's, let's say, the advice was create regulated FMIs in different jurisdictions and then connect them. So, and basically, this system will allow then the participants of that payment scheme to conduct or to make peer-to-peer transactions, wholesale transactions in their jurisdictions over a central bank account. The second item in the middle, what I already mentioned, is now we will replicate the same setup in different jurisdictions. Now UK first, and then there's Europe, US, and so on. And they will be all connected. So for the banks, for the users, it will be one global system. But underlying, there are different FMIs in different jurisdictions and are fully regulated. And the third one, going back to the research project, that's basically where that system can connect now with various blockchains. We have already, let's say, done quite a few POCs, also public, where we were able to connect to blockchains hosting tokenized assets. With that in mind, let's have a quick look at the key use case. So while you can obviously do many things like cross-border payments and so on, but really the key use case of Finality is to be that cash leg for the tokenized asset market. That was basically the vision or the key objectives of those banks in the research project. Let's have a look at an example. Now you have Bank A and Bank B, and they want to trade a, let's say, tokenized bond over a blockchain platform, and they will agree on the trade terms via that platform or some third-party trading application. And once that is done, now that's basically done, the ownership now of that bond will be then transferred via that blockchain, let's say from Bank A to Bank B. But what is missing here is someone needs to pay for it. Now, in the end, money needs to flow. So Bank B needs to pay Bank A. And that's where Finality comes in. So basically what it means, or how it could work or will work, is that Bank A and B not just have to be members of that asset blockchain, they also have to be a member of Finality. And again, once the trade has been agreed on, let's say that's whatever trading application, that information will then be passed on to that asset blockchain and to Finality. And then those 2 blockchains then will talk. Now they will have that atomic settlement protocol where both chains then make sure that only their transaction will happen, cash will be transferred or asset will be transferred if the other one moves. I mean, I could talk another 30 minutes about how that works, but you have to trust me in that session that it's basically absolutely safe, that now it's atomic, that now only the cash will move if the other leg will happen. So basically, that's it. Now, once, again, trade has been agreed, both chains will transfer the cash and the asset, trade done. And as mentioned by a previous speaker, that you can cut out, let's say, a lot of, let's say, inefficiency. And again, that's the key use case where, let's say, Finality can step in and is already partnering with various, let's say, providers of tokenized assets, marketplaces and platforms where we can then support in providing that central bank-backed cash leg. And this brings me to my next point. The last point, to look under the hood on how actually that system works. Again, that's a system in one jurisdiction, which will be then replicated in different markets. So there are 4 key components, as you can see on that slide. On the very left, number 1, now the key is a central bank account. So there will be, or Finality will open a central bank account in the various jurisdictions. Different names. In the UK, it's an omnibus account. In the EU, it's a technical account. And in the US, for example, it's a joint account. And that's where the funds of the banks, of the participants, will be held. And also very important, there will be a trust structure over that. Now, because again, Finality will be the account holder, and no bank will want to face off to Finality, because it's again, it's just a counterparty risk. But because it's a trust structure, now the money is safe. Now Finality is only the trustee. If Finality would, let's say, disappear, the money is still safe and is on the central bank account. So again, a very important item, a very important point to address. That first criteria, if you remember, it needs to have a similar credit quality than central bank money. Second point, funding and defunding. So these participants of Finality will have the ability to move funds from their central bank account they have, whatever with the Bank of England or with the Fed, to that central bank account held by Finality. They can do it, of course, during RTGS opening hours, but also one of the benefits here of that system, and overall that whole blockchain technology, you can use these funds once they are on this orange central bank account also during the night, 24/7. So basically, trades could happen also, let's say, if the Bank of England here, the RTGS system here in UK is closed. Number 3 is the blockchain. And we also very important to note here, we use the blockchain only as a means of recording which participants owns what share of the funds sitting in that orange central bank system. And of course, also if there are transfers, so if Bank A pays Bank B. It's very important to note that Finality is not, let's say, a stable coin where we hold money on behalf of someone. We are not a crypto asset, so we are not issuing any tokens. Really, the money will remain in a central bank account, and our blockchain will only, let's say, record now basically which bank owns what share of the funds sitting in central bank account. I think it's a very important point, which is also key when it comes to regulation and so on, because there's a lot of, let's say, new regulations about crypto assets in the pipeline. But our, let's say, a strong opinion is here that that's different here because we're using it in a different way. Of course, the 4th item, the validation process, the different nodes will be then hosted by the participants of Finality. And every time a transaction happens, and those nodes will independently verify. And I think it's 2/3. Now, if 2/3 of the nodes then agree it's a valid transaction, then it will be broadcasted across the blockchain, and then basically the payment is final. That's it with my quick whistle-stop tour across now Finality. what the product is, the key use case, how we intend to support the tokenized market ecosystem, and in a nutshell, how it will work. With that,
thank you very much. Thank you very much once again for providing an overview of how the settlement mechanism works within the tokenization space. But great to hear from Finality. Obviously, a lot of people who know Finality have been in the space for quite a while. But obviously, everyone may be quite keen to appreciate where you guys are from an implementation perspective. So I don't know, is that something you can share where you guys are with that?
Very good question. And some people say, look, guys, a research project started in 2015 and you're still 8 years on. But really the key is working with regulators and getting the regulation. Now, it's blockchain, the technology is one thing, but really to become a regulated status, become a regulated FMI in the different jurisdictions, that's a big challenge and it takes a lot of time. We are confident, or we're hoping that in Q4 this year, we can go live in the UK. We're quite excited. So it has been a long journey, a lot of hard work. And then next year, the plan is that we launch another system, either in the US or Europe. Nice. Let's see. But it's not just, let's say, an idea on paper and a vision. We are in advanced stages with those 3 key central banks, and we are in the middle of the application process, and hopefully watch this space. There's some good news end of this year.
Great. Which just basically tells the market that it's not just a future state from a theoretical perspective, but more practical sense as well. So thank you very much for coming over and educating us all in that. With that said, thank you very much. And we have 2 more individuals joining us. We have Bruno from Aberdeen, and we also have Graham from Archax as the CEO. They'll be talking about the use case from a funds perspective, which is going to be excellent because tokenization of funds is another good use case. So with that said, we have Graham who will be presenting us. So Graham, over to you.
Thanks very much. Yeah, thanks everyone. Great to be here. Thanks very much for having me, and such great content as well. Sorry I can't be there in person, and there's quite a lot to get through as well. So hopefully we'll get through it all, but if not, feel free to reach out to us at any point. I believe we're going to share the presentation. So yeah, so just a quick background on Archax before we start talking about the future of financial services. So about 5 years ago, we set up Archax, and we had this view. We kind of looked at crypto and said, look, this isn't about crypto. Every single asset class out there is going to be on chain in the future. This is about a ledger. This is about the way that we store records of ownership. And if you believe that this is a good technology for this, then you'll think it applies to all financial assets in the future. And we decided early on, if you think that's the case, a lot of financial services assets are regulated, and most of those assets are traded by institutions. So in the future, you probably need to be regulated, and if you think those institutions will ever come and trade with you. So we went to the FCA in 2018, and 2019 put our application in 2020 became a regulated digital securities exchange, custodian and broker, as well as getting the UK's first crypto asset registration. So clearly we have a big long-term belief in all assets classes moving on chain. And kind of the turning point for us was at the hedge fund we were at, kind of thought through the life cycle of a trade and said, if you're an investment manager, you trade on an execution management system. These trades go to a broker. Those trades then go to an exchange where they're filled, and then usually there's all these counterparties to a trade. And what happens is everyone in financial services maintains their own ledger, either for record keeping requirements or just they don't trust other parties. And the result of this is you end up with this really kind of confusing back office process where everybody's reconciling the same trade backwards and forwards to each other. And what we quickly realized about this blockchain technology was if you were to exist in a regulated framework, and rather than everyone just maintaining their own ledgers, everyone sat on a blockchain network, then theoretically what could happen was if those instruments could exist in token form, then when a transaction happens, they're just available to everyone across the network. And so whilst the counterparties might change, the principle still remains the same. If you can have these assets on chain, there's a lot of efficiencies in terms of corporate actions, in terms of settlement. And that's kind of the the future that we're looking at. And so, when we're thinking about a token, there's so many steps that go into it. And we've spent 5 years speaking to people, working with great partners like Securitized and Tokeny, and walking through the various stages. And the truth is, it's quite complicated. There's a variety of regulations in each jurisdiction. There's different laws that are in place. There's different asset types. There's different regulations for each counterparty. So there's a lot to go into it. And whilst we can all kind of believe the vision of smart contracts, automating regulation, automating rules, the reality is we're still quite early days. So most of the instruments that we see at the moment are quite straightforward. But where we hope it gets to is full corporate actions on chain. We just heard from Finality, I think having a digital currency that can sit alongside a digital asset is exactly what we need to get to the next level. So a lot is going on. There's a lot of thought needed into each of them, but we're definitely heading in that direction. And I think everyone's moved from is this happening to this is definitely happening. It's just when for most of those asset classes. And specifically, Archax last year engaged in a partnership with Aberdeen. I'm sure we'll hear more of that in a minute, but funds have always been pretty close to my heart, and there's a couple of use cases there that people talk about often. Now, when we speak to asset managers, there's a few reasons that they're usually interested in tokenizing their funds. Bruno's going to run through some of those in a minute, but the one that kind of seems to spark most people's interest is this idea of liquidity, specifically around illiquid funds like real estate funds. Just to walk you through an example of where that may be interesting to people. Quite often, if investors want to redeem from a fund that's illiquid, they place their redemption order, and unless the fund manager's got money, they have to potentially sell an underlying asset. And this is hugely inefficient for the investment manager. They lose fees, they get distracted from their portfolio, and in some cases, they have to unbalance their portfolio. If we can tokenize these assets in much the same way that we talked about earlier, then those assets can be traded on our venue. You can still maintain the underlying liquidity schedule if you want, but you could have a tokenized feeder or a tokenized interest in these funds that's available to be traded on Archax, creating a secondary market and hopefully not creating the sort of liquidity issues that a fund manager faces. So, this is one of the main use cases that attracts people to the space. And they often talk about some more of the benefits, but this tends to be the one that's the focal point for most people. With that, I'll just hand over to Bruno, who'll give you a bit more information on what Aberdeen are looking at and how they see the space.
Thanks very much, Graham. Thanks, for having us and speaking at the summit today. I'm very, very glad to be here. If we can then, in terms of the before I dive in, I suppose, to the main topic and continue from Graham's presentation, I thought I'd cover briefly the strategy that we have in place at Aberdeen in terms of digital assets. And you can see 3 pillars on the screen. The first one is around producing and delivering a set of investment products for our clients that give them investment exposures to the technology investment of the future, such as blockchain. And so we are working on a number of products that will essentially help our investors benefit from the growth in this area and the adoption of DLT in particular. Then the second pillar is around the way our clients access our products and also how we apply technologies such as blockchain to our business. This is where fund tokenization belongs, and so I'll cover that a bit in more detail a bit later. But yeah, that's the key one for today's topic. And then there's another third pillar where we want to be invested in the infrastructure itself, and participate in driving the industry forward, in the adoption of DLT, which essentially means getting ourselves involved. So Graham obviously mentioned our investment in Archax, and there's another one we announced recently to the market around our commitment to a particular DLT, which is Hedera Hashgraph, and so I'll cover that as well a bit later on. Now, to the main topic then. So why, from the perspective of an asset manager like Aberdeen, and what do we see in fund tokenization? So Graham obviously covered this already. So there's, and along with other participants before that, in terms of deriving a number of efficiencies and simplifying the workflows that underpin a lot of the processes that happen, and in our case, in terms of fund servicing and the various workflows associated with all the partners we work with. So what that means in terms of applying this from the perspective of the investor then is, obviously, by reducing this operational burden, we hope that we can ultimately offer access into our funds at a lower price and compare favorably to current ways that our investors access our funds. So that's achieving lower costs is really a key achievement, a key goal for fund tokenization. But also from a product perspective, there's also other benefits. Private funds and the way customers are currently able to engage in private markets investing can be difficult. A lot of the time, it can require high investment minimums, and through tokenizing fund interests, we can envisage ways where investors, a larger set of individual investors, can enter and can have access to exposures into less liquid products. And then Graham covered the liquidity aspect on the secondary market. That's also a key benefit. So on venues like Outchecks, you could envisage for investors to be able to access efficient secondary trading venues where they can have secondary liquidity there on funds, which again on the primary can be quite illiquid. And there's other benefits that are on the slide. There's one maybe to point out on transparency. So obviously by using DLT, you can envisage again to have benefit investors in the way that transactional data is more transparent on chain, not just for the participants and fund servicers, but also regulators, fund auditors, and that again should lead to efficiencies. Now moving on to the next slide. This is an attempt just a depiction that I put together to essentially convey what the future ecosystem for of investment funds, so tokenized investment funds, might look like. This obviously this is quite far into the future. This assumes that the blockchain has been essentially fully integrated into the model. The interesting bit here is obviously we represent the investors as well. As you can see, the whole model revolves of having a range of tokenized funds issuing fund tokens to investors, and allowing investors, whether they are retail investors or sophisticated institutional investors, potentially based in different jurisdictions, all to have access to our funds, which they can get through primary market, which are the blue arrows there, either via digital platforms or directly into our funds, and also have access to secondary liquidity, also again through digital platforms initially, but there is even ways that we can envisage for peer-to-peer transactions to take place on the network, further down the line. And again, this assumes, you can see the fund supplier there at the bottom. Obviously, this assumes that the fund, all the processes that help support fund investments in and out of funds are obviously all benefiting from a lower operational burden associated with being on chain. And that's really sort of a projection to sort of a future that we are working on at Aberdeen. But clearly, there's a number of hurdles. I know regulatory implications have been mentioned by earlier sort of speakers. But yeah, here for those familiar with this, you can imagine clearly that to take an example around AML, and KYC, eligibility concerns as we operate in the regulated fund space. There's a few steps to get through. You'd envisage that for this to be happening, the token construct should be a lot more sophisticated than it is today, as Graham was mentioning earlier. And so for these elements and these components of assessing eligibility and suitability are essentially integrated into the token itself. And that's where ultimately you can hopefully have those peer-to-peer transactions that we see. Now, if we go back to back to today, this slide is highlighting the two commitments that Aberdeen as a firm made. So Outchecks, I think we've spoken about already, but I think just to point out, as a regulated fund manufacturer, that the FCA regulation and the FCA permission, that Outchecks has is critical for us to be able to leverage and get us to market with a tokenized fund. And the one that's related to the third pillar of our strategy, which I covered earlier, is around it's quite evident with our our commitment to the Hedera Hashgraph DLT, and this is again having an asset manager firm, pretty traditional asset manager, joining the governing council of a distributed ledger technology firm, and essentially being able to opine upon how the DLT is going to be run, how any regulatory topics, technology matters, use cases, and so it's a pretty big evolution for us as a firm to essentially be operating a node on the Hedera mainnet, and validating transactions. So just conscious of time, I'll try and sort of cover this one, and I won't cover every aspect of it, but I thought I would sort of provide a reflection of where we see the bulk of the work ahead for fund tokenization based on our experience so far. And maybe one to point out that's quite interesting is for many colleagues and customers still, and obviously depending on the sophistication of your investors, that becomes more pronounced. But the blockchain itself still has pretty Wild West sort of quote unquote connotations, still associated with potentially high gas fees, high environmental impact. There's still people still associate tokenization with cryptocurrencies and high volatility, and there's been tremendous progress already internally, for firms like ourselves, and in terms of starting to educate our customers with what the benefits of tokenization can be, and how actually we leverage the infrastructure that's been powering crypto for decades now, but actually the exposure you get at the end of it can be varied depending on the actual investment product that you buy. So that's been quite an interesting journey. And another one potentially to point out is the different stages that the various parties that we're working with are at with regards to the adoption rate of the technology. Many partners that we work with are also on their discovery phase and their discovery journey, and this affects essentially how ready they are to deploy fund tokenization solutions that can be scalable. So there's something to really take into account. I think what we're trying to do is fairly complex, particularly in the space of in the regulated fund space, and there's a lot of regulatory sort of issues and firms involved, and there's many firms involved, I suppose, in that process. So yeah, taking everybody along is very interesting. And again, in terms of the progress, just to point out that it's not a matter of whether it will disrupt the market that we think, it's how quickly that adoption rate will be, so that we can get there, and we think it can actually be a lot quicker than we imagined. So yeah, I mean, quite a long list there. I think I'm kind of running out of time, so I'll hand over back to you, but I hope it was helpful to hear where we are from the perspective of a large asset manager, like Aberdeen, and yeah, I can come back and give an update later, I suppose.
Thank you very much.
Thank you.
No, thank you very much, Bruno. But before we leave you, very quickly, Graham, from your perspective, we obviously heard from the road moving forward from Aberdeen perspective, but equally, we just wanted to get your last comments as well before you both leave us. Are you seeing something similar from macro level, or are you seeing different challenges to what has just been talked about in the slide before?
Yeah, I think the macroeconomic backdrop for crypto and crypto winter and all the issues we had last year have slowed some things down in the crypto asset environment. But from a tokenization point, I don't think that happened at all. I think the technology never failed in any of those instances. It was mainly to do with the lack of regulation or the lack of good governance. So what we've seen actually is all of the institutions embracing this moving forwards. Most of the institutions have gone from kind of one or two people on the desk to whole teams looking at this. We're seeing a huge influx of asset managers looking at fund tokenization, distribution platforms, and actually we're having more interesting conversations with financial market infrastructure participants as well about taking traditional instruments and putting those on chain and starting to consider, how can we move traditional securities onto some of the more innovative things happening in DeFi. So I think there's a road ahead. I think it's going to happen, like Bruno, quicker than everyone thinks, but I still think we're on a bit of a journey. what's going to happen before the end of this year, I'm sure, is 2 or 3 very live cases coming out into the market rather than remaining internal POCs.
Brilliant. Okay, thank you very much, both of you, once again for helping us out and educating the market. With that said, I think we'll move on to the last session when it comes to tokenization from a future state perspective. And we have Emma from JP Morgan. So over to you.
Perfect. Thank you so much, everybody. And thank you for having me at the EY Global Blockchain Summit. My name is Emma Landrio, and I'm here as part of the Onyx by JP Morgan team, where our goal is to re-architecture the way that money, assets, and information are being moved. Within that team, I sit in the coin systems team, where we are responsible for the flagship product, JPM Coin, as well as looking at the development of deposit tokens. So today we will continue the conversation on deposit tokens based off a white paper that we have published a few weeks ago. So deposit tokens really emerge out of a search for a more stable form of digital on-chain cash. This was a means of payment at scale or for collateral. And this has become more prominent as the tokenization ecosystem has continued to grow. Today, this gap is really largely filled by stablecoins. However, stablecoins do have some really key issues, of course, being unregulated for the most part, but also difficulty maintaining the singleness of money, which is critical to our financial system, as well as a difficulty in maintaining value, depending on how these stablecoins have been designed and what kind of baskets of reserves are behind them. And so future looking, I think what we've really looked at and what we've really seen has been the prominence of a wholesale central bank digital currency as a means of settlement in the future. And we believe that this will definitely be the case, particularly for systemically important financial flows, where central bank money is the absolute best way to be settling certain types of transactions. However, we don't yet have a large-scale implementation of wholesale central bank digital currencies that can be used for these types of transaction flows. So this is where we've really seen a gap in the market to create a need, or I suppose assessed a need, for a tokenized form of commercial bank money. After all, commercial bank money is the most widely used type of money today. We see a need for it where commercial bank money is already used for settlement, but also in the interim as we are waiting for wholesale central bank digital currency for this type of settlement. Our response to this has been deposit tokens. Importantly, not a tokenized deposit, but a deposit token, which we'll discuss a little bit more. But really, this refers to a traditional fiat demand deposit that is blockchain native. And we believe that this form of deposit can bring scalability and stability to the tokenization space and provide a form of regulated, stable digital currency for the tokenized economy. JPM is really focused on developing out deposit tokens in order to support the growth of this economy. There we go. So what are deposit tokens? Deposit tokens are really just a digital evidence of a demand deposit claim against a issuing institution for a fixed fiat amount. And importantly, that claim is specifically to the token holder. We define deposit tokens as native instruments where the book of record is the distributed ledger itself. That means the total amount in circulation and the source of truth that the banks are using are this distributed ledger or the blockchain ledger. And that represents our single source of truth. It is not a representation of a digital asset off-chain that is brought on-chain where there is an actual off-chain ledger to reconcile against an on-chain ledger. And the reason that we make this distinction is because we believe to truly exploit all of the value that distributed ledger technology can bring, we need to have a native instrument that can enable use cases where assets and cash can both be issued on the same chain. If you are stuck doing off-chain workflows, there's going to be a variety more requirements to meet and latency in these workflows. I think really importantly, one of the characteristics of a deposit token is that it can be underlied or started the development on an ERC-20 contract standard. Of course, there will be composable elements to it because we will need to be providing other identification capabilities, potentially even contracts that on top of it that bear interest or different types of functionality that will make these resemble demand deposits, but ERC20 can be the underlying protocol so that we start with a more interoperable version of the contract standard and then are able to build towards it so that we can move towards a new contract standard for these types of tokenized deposits. This was a design decision that we've been exploring so that we can make interaction and interoperability at the very core of this type of solution. With that in mind, of course, there's issuing ERC20 tokens in private instances or side chains or even public chains. And I think what's really important is that with these decisions, we're able to ensure that we can implement functionality to control access on these deposit tokens. And we actually developed a project called Project Guardian, where we issued deposit tokens opposite SBI holdings for an FX transaction between Japanese yen and Singapore dollars, where we used restriction controls and verifiable identity capabilities to create a trust ecosystem to transact with a financial institution across a public chain. And we'll dive a little bit further into that. But I think importantly, it's, important to kind of anchor this conversation on how do deposit tokens really fit the evolution of the blockchain space, and how are we here at JP Morgan across our product stack developing for that space. We largely see this space emerging with three types of ledgers. The first is a single bank ledger. This replicates the existing bank ledgering systems, however, brought onto a distributed ledger infrastructure. It's a closed loop environment where the bank itself will hold and control its own ledgers and holds the accounts who transact in between those two ledgers. And we have a version of this that's actually live today called JPM Coin, which is a blockchain-based deposit account. It allows for JPM clients to move money across their accounts domestically and cross-border at a 24/7 cadence. It also brings in programmability elements to it and brings a lot of efficiencies for use cases like margin financing or intraday repo. Where time and risk can be reduced by transacting with blockchain deposit accounts. The next type of ledger that we see is really a shared ledger. This is where two or multiple financial institutions will come together for specific types of transactions and transact on the same ledger so that they're all sharing the same source of truth. This is really relevant for payment versus payment use cases and areas where peer-to-peer is beneficial, as well as where reconciliation traditionally is required. It can remove the need for interbank reconciliation. We have an example of a ledger like this within our specific ecosystem. We have invested in Partior, which is a multi-bank FX ledger that allows for ourselves, DBS, Temasek, and Standard Chartered to transact on the same ledger for FX transactions. And then finally, we have this view of the universal ledger. This, I guess, is on the topic of future looking. This is where interoperability is really maximized, and issuers can use controls to create trust environments on a universal ledger. So I talked a little bit about Project Guardian. This was an example of a universal ledger POC, and it was also a first pilot of deposit tokens. Under the supervision of the Monetary Authority of Singapore, we made a Japanese yen to Singapore dollar FX transaction on Polygon opposite SBI holdings. We leveraged verifiable credentials to help restrict any unknown parties from transacting with the token or protocols. We also implemented transaction restrictions to ensure that only verified parties could actually instruct the transactions or engage with our smart contracts. This was an example of implementing a couple different controls to create a trust ecosystem on a public blockchain, proving that it's possible and that deposit tokens can be used in that context. And I think before we move on, one last point to regard here is that, importantly, we don't think that it's going to be necessarily an evolution across each ledger as much as we see specific use cases being relevant for these three ledgers, and we see interoperation or a choice in which type of ledger to use based on the use case. And that's why our product stack also reflects this paradigm. Now, finally, I won't spend too much time here for the brevity of the session, but I just wanted to quickly remark that today we are really advocating for deposit tokens to kind of fall under existing depository frameworks and maintain the characteristics of traditional deposits. So unlike stablecoins, and even possibly depending on how CBDCs are designed, we see that deposit tokens would still have very similar reserve and liquidity requirements as traditional deposits do today. They would maintain deposit insurance and protection and have to be designed in a way to maintain those capabilities, as well as potentially have the ability to be interest-bearing, which is a big differentiator from central bank digital currencies. And because of this, it makes them incredibly suitable for some specific use cases. First is payments. So, today, with payments, it's quite a fractionalized system. It relies on different technology players and complex correspondent networks if you're making cross-border payments, or latency due to end-of-day settlement constraints if you're talking domestic payments. With deposit tokens, we're looking at a technical solution that amalgamates the clearing and the settlement layer to make these payments frictionlessly, whether they be domestic or cross-border. They're able to ensure that you can interact across time zones, and it results in less capital locked in flight and finality in the process. Secondly would be programmable money, perhaps more of a feature, but by developing on an ERC and EVM compatible chain, we are able to bring programmability into the scope so that we can automate the execution of complex logic. Finally, or not finally, third, protocol interaction is relevant here because by creating a token form of a demand deposit, we are actually able to use these deposits for use cases that are traditionally locked into DeFi or that require a token form like automated market making. And in fact, we did interoperate and interact with the DeFi protocol with Project Guardian. Finally, trading and settlement. I mentioned this a little bit, but I think that trading and settlement is one of the biggest use cases here because it enables us to actually issue assets on a side of a DVP and deposit tokens on the same chain to create truly atomic settlement, which reduces counterparty risks and bring transaction finality into the process. It's kind of our target state for DVP transactions on state. And then finally, it also opens up to new means of collateral in order to use these means of collateral in on-chain environments, specifically in things like intraday repo. And I will just move ahead because I know that we're running out of time, so I'll very briefly just go with a few, a few key takeaways that we can discuss before we get into questions. So to conclude, we believe that deposit tokens can become a very strong foundation for digital money, an important part of the tokenized asset ecosystem. We believe that they will work alongside other innovations like central bank digital currencies, so we won't migrate away systemically important flows and have a potential adverse impact on financial stability, but instead enhance these flows where commercial bank monies can be used in specific use cases. And then finally, deposit tokens aren't actually a new form of money or a new type of digital currency, but instead a new technical solution that represents an existing form of money. And we believe that this will help bring maturity and stability to the market. So that's it for my presentation. Thank you so much for having me.
Thank you very much, Emma. I think before we let you go, if I was trying to summarize, it seems as if this is becoming better to the ecosystem that we already have, which is stablecoin and CBDCs, so quite future state. But one question, just because I was moving around and people asked that question, and I could see it in one of your slides as well. Deposit token isn't really a JP Morgan coin. So could you just reflect on that as a matter of a summary, just so that people can take that away to say, you know, this is something different, not the same?
Yeah, definitely. Yeah, that's a fair question. And I think we get that asked a lot. And I would say, you know, the biggest difference is kind of going back into that like ledgering environment, right? A JP Morgan coin, what it really refers to is a blockchain deposit account. This is always created for our JP Morgan customers. And so it's a closed loop account, essentially moving the messaging across the two various counterparties or potential other various counterparties in a transaction. Now, it does bring a lot of value, particularly when you're thinking about things like margin financing or large corporations who are moving a lot of money either domestically across their footprints or cross-border across their footprints, because we do support multiple types of currency on JPM Coin. So it's more so of that closed loop kind of system. Now, when we think about deposit tokens, we're kind of looking at that next iteration of where can we create a traditional demand deposit and bring it into issue it onto another network outside of JP Morgan, or perhaps inside JP Morgan, but on another network that's not directly account linked, so that we can enhance the utilization of these tokens and perhaps the transferability of these tokens.
Brilliant. So thank you very much, Emma. I think we talked a lot about tokenization in the future state. We talked about the custody, the blockchain protocol. We talked about Finality from a settlement perspective, use case from a tokenization of funds, and obviously the deposit token as another use case. So thank you everyone for helping us. And I think on that note, I will have to hand over to Amarjeet Singh on the last session of today. So thank you very much for having us, and Jeet, over to you.
Thank you very much, Laik, and thank you, Emma, and thank you all the brilliant speakers we've had today. We are on the final stretch, but saving the best for the last. Well, going from one firm which I was an alumni of, and now going to another place where I was also an alumni. We've got Keith Baer from the Judge Business School in Cambridge joining us. Keith, we at EY have been big supporters of the Cambridge Center for Digital Assets. We think that they've been doing some brilliant work. And so we are really, really pleased actually to have Keith sort of close off today of our FS Financial Services Day, talking about the journey that we are on. Hence the rail analogy on the slides as well. But talking about that journey that we're on in financial services, you heard a lot from the speakers today about where we see the world going to. And now, very, very pleased to introduce Keith, who's part of the brilliant faculty over there, to give us his thoughts, his views. He's doing some great work with global regulators in this space as well. And I'm sure you all have seen the emissions index, which again, the team at Cambridge has put out. So over to you, Keith, to give us your thoughts, really, sir, about where you see all this going.
Thank you very much, Jeet, and thanks very much for the invitation to speak to you. So hopefully the slides will come up quickly. And if we move on to the next slide, assuming my clicker works. Thank you. So just to introduce ourselves, I mean, as Jeet said, we're a research center, part of the Judge Business School at Cambridge. We're about 70 odd people now, some of them very odd. And we focus on four main research streams, one of which is digital assets, but we also look at subtech, at regulatory innovation, and also we have a fintech observatory. And within digital assets, we are supported by 14 public and private institutions, the likes of Goldman Sachs, Fidelity Digital Assets, World Bank, IMF, and also EY, which we're very grateful for their support. So what I'll be talking about in the next 19, 20 minutes, as Jeet said, is the kind of journey I think we're all on at the moment. And I'll be trying to ask one particular question, which is, are we seeing a migration to increasing utility in terms of the world of digital assets? So there is a poll that may pop up, and really it's just asking those of you on this session as to what extent you're already looking at a strategy in the process of developing that, or do you already have your strategy fully developed? This is a slide that comes from Citibank in terms of a survey they did. And I think it's just really interesting to see where the folks on the call at the moment are on that journey themselves. And certainly I think it's a great time for management consultants because of the fact that, as we can see from this survey, 63% are still in the process of defining exactly what their strategy is going to be. And that's very much consistent with many of the discussions I'm involved in at the moment with banks, institutional investors, FMIs, et cetera, working out exactly how they're going to engage in the market given what is happening. And that's really what I'm going to be covering in the next few minutes. It's worthwhile, I think, just going back to a little bit of basics. What is it about when you're trying to represent an asset digitally? Where do the challenges actually come from? And obviously that the problem we have then is that of digital abundance, that you can basically copy and paste, if you like, representations of a digital asset, or you have the problem of the double spend issue. And the way that obviously traditional finance has got around this problem is by having trusted third parties, such as the exchanges, the clearinghouses, CSDs, et cetera. And the fundamental difference in terms of what blockchain and DLT technology gives us is the ability to have an intrinsic relationship between the asset and the value transfer infrastructure that supports the movement of those assets in terms of ownership, as opposed to the separation, the extrinsic relationship between assets when they're digitized as opposed to digital, and the value transfer systems that support them. And obviously this has many implications in terms of being able to reduce cost, reduce complexity, take friction out of the system, and that's really what we're seeing on multiple levels. So in terms of the journey, I'll spend a couple of minutes on crypto, a bit more on DeFi, a bit more on asset tokenization, and ending up with some comments on Web3. And the reason for doing this in part is because I think we've had a tremendous set of speakers today for QEY for doing that. Rather than try and repeat anything that they've said, because they said it probably much more eloquently than I can, I'll try and just recap some of the key points in that kind of regard as well. And the key question I wanted to ask, as I said earlier, is the question of utility. So where does the real utility come from? Because one of the major criticisms, obviously, that we've had with crypto, if I go back a slide, is when you have an asset such as a crypto asset, which has no backing in terms of an asset behind it and has no cash flows that are supporting it, is there any intrinsic value as far as a crypto asset's concerned? And obviously, there are a load of conferences going on this week in London, the FT conference, for example, and ONFIF, and obviously this conference. And that's one of the key questions that raises its head many times. And obviously, we have seen the decline in the crypto market over recent months. But obviously, there's some key factors I think that have come out from that. One I've heard multiple times, which is the flight to quality argument. This has been to the benefit of the likes of Goldman Sachs, JP Morgan, and Fidelity Digital Assets, for instance, taking a benefit because of their reputation in the market following the failures of FTX and other entities. Just an example, DBS's digital exchange in Singapore, for example, saw volumes up by some 80% following the failure of FTX. Obviously, regulation is one of the other key themes going on. And again, that's been talked about extensively today as well. But the big question, I think, is do crypto assets really have potential for utility? And that, as I said, is something I'll come back to at the end of the presentation, because I think based in the context of Web3, we're beginning to see the early signs that that utility may in fact exist. Moving to DeFi, the kind of second step on the journey. Some of you may be familiar, obviously, with the DeFi structure, the settlement layer built on public blockchains, the asset layer, be they crypto assets or stablecoins, for instance, the applications, be they DEXs or credit applications, protocols, insurance, derivatives, etc., and the aggregators sitting on top of this. This chart originally came from about a year ago, I think. So obviously the total value locked is somewhat less, around closer to 60 billion now than the figure on the chart. But it still gives an interesting illustration of the relative size of DeFi, and is also something that is actually of great interest to us in terms of research questions at Cambridge at the moment, as one of the ideas we're building with the community of supporters is how we could develop a DeFi navigator to help explore the way that DeFi protocols are reflecting how that composability of the technology is being implemented in practice. But the point I wanted to make here is DeFi really just a means of being able to give another vehicle for speculation, or is it showing signs of potential utility? And I would argue, and we've already heard some aspects of this already, the potential for utility is clearly there, I think. The graphic on the left comes from the IMF. Some of you may be familiar with it, but it gives an illustration of the relative cost of a DeFi protocol based on an analysis by the IMF, comparing it to developed market banks and non-banks and emerging market banks and non-banks. And as you can see on the graphic, a significant lower cost, around 2% marginal cost, compared to the raising costs, as you can see, depending if it's a bank or a non-bank in a developed market or an emerging market. And that has obviously given some incentives. It's not just about cost, obviously, but it's certainly giving some incentives for the institutional investigations that we're now been seeing in terms of how this could work within the institutional environment. We've already heard about Project Guardian from JP Morgan, which I think is a great example of illustrating this. SocGen obviously just issued a stablecoin, but have been very active, I think, innovatively in terms of their work with the MakerDAO credit protocol in DeFi, withdrawing $7 million in the DAI stablecoin, for instance. We've also had MakerDAO themselves, who have been pushing the envelope in terms of real-world assets, $500 million in US treasuries and corporate bonds, for instance. We have the Project Mariana initiative taking place with the Swiss National Bank and BIS, etc., which is exploring how to use the AMM, automated market maker protocols from the world of DEXs in the FX world. And we also have Swarm as the first regulated by BaFin DeFi protocol, a DEX, now offering, I think, shares or tokenized shares as far as Apple and Tesla are concerned. So again, I'm sure there'll be many more examples as we go through in the next coming months, which will illustrate just how this world of institutional finance is taking advantage of some of the innovations that are happening within the world of DeFi. So I think there is utility there. We've also talked quite a bit today, for example, from Boris from Copper, in terms of the bigger question of asset tokenization. And obviously, when you look at the overall financial markets and the trillions of dollars represented there, this represents a far bigger potential than the crypto asset market cap at 1 trillion, give or take. And this slide you may have seen from Citibank's recent release gives an illustration of just how big that prize may be in terms of the kind of assets that might be tokenized, including real estate, obviously, and in particular private markets, private equity, et cetera, by their estimate around 5 trillion. So how could this be realized? I've borrowed a slide from Goldman Sachs, one of our supporters, but this just gives a simple illustration of the tokenization process itself. Some banks, such as Goldman and HSBC, for instance, have been building their own tokenization platform. Others are using some of the commercial offerings out there, such as Tokeny and Securitize and others, but essentially being able to go through a process of either taking real-world assets and being able to create a token representation of those, and this is kind of illustrated on the chart, or by issuing a native digital asset, which only exists on the blockchain itself, as in the case of some of the digital bond issuances that have happened. So is it just Citibank's perspective on the trillions of dollars that are represented? Not really, I think. Again, some of you may be familiar with this analysis from BCG and ADDX, which gives an illustration by their estimates of around a $16 trillion opportunity by 2030 associated with the tokenization across the different types of asset classes, as you can see, in terms of, and in particular, private markets. I think one of the interesting questions is, when might we see this? This is a survey by ISSA, the International Security Services Association, which gives an illustration of based on a survey they did on the activity going underway as far as tokenized assets are concerned, both in terms of the pilots that are taking place, but also more critically in terms of the planned live deployments. And whilst they very carefully didn't put a scale on this slide, I'm afraid, it does give an illustration of the fact that there is a significant activity in the industry at the moment, looking at migration from POCs into live deployments. And of course, we have the public examples of that already in terms of the digital bonds, as I mentioned, with over $1 billion already released, issued on digital bonds, such as HKMA, ERB, et cetera, and obviously private equity with the launches by KKR in terms of part of the fund that they tokenized, and more recently Hamilton Lane tokenizing 3 private market funds, and obviously that journey is continuing as well. Exactly what the rationale and the benefit for this is. I mean, I hope Aberdeen don't mind me borrowing some of their statistics, but this was shared by them at the Paris Blockchain Week, and I think gives a really good illustration. If you look at US endowment asset allocation for funds with more than $1 billion, there's typically a 30%, 37% in this case, exposure to public markets, and 63% to private markets. And over 2022, in terms of fiscal return, just looking at a minus 4.5% loss, compared to much smaller funds or even mass affluent, where there's limited or no access in the case of mass affluent to private markets, and a much greater decline in return that those particular groups had in that respect. So really, the investment democratization is there's an article in the FT, I think, on this question just now, which gives an illustration as to what the potential is of asset tokenization, opening the investor base up to a much greater extent, increasing liquidity in the market, et cetera. And that point is kind of illustrated again by this survey by Boney, which gives an illustration again of the asset classes the most likely to be at the forefront of the tokenization journey that we're talking about here, as well as the rationale being both about democratization and increasing shareholder or investor reach, I should say, but also taking advantage of the blockchain platform itself in terms of its immutability and transparency, and of course the increase in liquidity that this kind of approach can generate in that respect. Again, I think this resonates, I hope, with you, based on some of the conversations we've heard from earlier speakers as well. And it's not just about that side, it's also about the back office, the post-trade area. This is an analysis by Keyrock and Roland Berger, which was an attempt to estimate what the post-trade savings may be by their estimate around 0.9 to 1.4 billion euros by the midterm, 2025 or so, rising up to 4.6 billion by 2030. And we obviously heard from Finality a little earlier, and that's the example of, I think, of the kind of initiatives that really can make significant impact as far as post-trade costs are concerned to the better wealth of all types of institutional and retail investors in that respect. But all of this is dependent really on having tokenized cash being available. So this is just the spectrum that we have, obviously, from the on the left-hand side, the crypto asset world, Bitcoin, Ether, etc. Those stable coins issued by non-bank companies such as Tether, USDC, etc. Those issued by commercial banks, JP Morgan in terms of a deposit token, and also more recently from SocGen, the Forge division of SocGen, with an actual stablecoin issued by the bank. And then also we have USDF, the Australian banks that are active in this area. And then moving to the right, the synthetic CBDC, such as Finality, as we heard about earlier. And of course, the CBDC, the actual liability against a central bank, which obviously is in some respects, the ultimate ability to be able to provide risk-free cash assets as far as that's concerned. So obviously there's a huge amount of development. We have regulation affecting stablecoins. We have the banks being very active in terms of tokenized bank deposits. Peter from Lloyds touched on RLN a little earlier, so exactly where universal ledgers may head, and obviously what the central banks themselves may do as far as CBDC is concerned. But all of these developments are really critical in terms of actually realizing the real promise as far as asset tokenization is concerned. I just wanted to close with Web3 and going back to my earlier point on crypto. And again, I'm sure you're all familiar with this idea of Web1 being focused on more of a read-only kind of capability around technology and architecture. Web2, as we experience today with the read and write, but being able to create a platform for large centralized rent collectors in terms of the big tent firms being able to leverage and monetize data that comes from both consumers and providers in that respect. And Web3 basically being about using decentralized technology, blockchain technology, governance by token allocation, and being able to give a reward mechanism for both consumers and providers of content in that kind of context. So I'd like to ask a hypothetical question in that respect. If there were innovative Web3 apps that really drew user value, that gave stakes in their ownership and the governance in terms of helping to those that help build the network, both in terms of content and consumption, and that value is represented by a form of crypto, then could that really see an evolution in terms of business value from these applications, and critically real utility as far as the asset that is concerned that is represented within the Web3 environment? So to answer that question, I'm not saying this is the answer, but I think it's a really interesting example of what's happening at the moment, where the innovation is, and I think it's an interesting illustration to the answer to this question. So I'm hoping the video is going to play, and I'm hoping you can hear it. But this is Hive Mapper for those not familiar with it.
Yeah, that's me.
Are you a skater?
It's roller derby.
Well, then let's roll. I bet you're wondering what this is.
Nope, just...
I used to get my directions from using apps like Google.
Used to?
Yeah, I mean, don't get me wrong. Google Maps is fine if you're okay with them profiting off of your data without you seeing a penny of it.
Wait, what?
Yep, and their maps are super expensive to create, which means you're probably using an outdated map.
So, if you don't use Google Maps, what do you use?
Hive Mapper.
Hive Mapper?
Mm-hmm. Hive, like the beehive. It is a decentralized mapping network, and I'm like a wee worker bee, helping to build a big global map just by driving, and they pay me in crypto.
Wait, did you say you get paid in crypto?
You get tokens just for contributing your mapping data.
What crypto do you earn?
Honey.
Oh, Hive, honey, bee, sick.
And it's so easy to use. All you have to do is place the Hive Mapper dash cam in your car. It automatically uploads street-level images via the Hive Mapper app. And then the app deposits honey cryptocurrency into your account.
Just for doing something you do every day?
Mm-hmm.
Nah, that seems
Too good to be true.
It's too good to be true.
But I'm not a rideshare.
Or a delivery driver. Can I still use HiveMapper?
Oh, anyone can do it. That is the future. Regular people like you and me. And what's in it for us? Map ownership and crypto. You can easily download the HiveMapper app. Just go to www.hivemapper.com.
You don't have to say www anymore.
Or you can scan the QR code.
I think you mean QR code.
Oh, potato, potato.
All right, drive safely.
Don't forget to check out HiveMapper.
Will do.
Okay.
So I think that's a very interesting example. Whether it succeeds commercially or not, I'll leave that to others to judge. But it has grown 30 times in terms of its user base in the first 3 months of this year. And it's been estimated by Masari that it'll have the complete LA road system mapped within 3 months. So really interesting example from my point of view in terms of a Web3 based application. And obviously there are others along similar lines as well. So really just in closing, I mean, obviously crypto down but not out in some respects. And I won't repeat what I've said before, but really interesting in terms of the shape of the market that's developing at the moment. The much bigger in terms of market cap is obviously the bigger question around asset tokenization and some of the drivers that are taking that forward. And then finally, with the investment that's been made over recent years as far as Web3 is concerned and the kind of innovative models that are coming out, my question being, is this now an opportunity to see real utility as far as crypto assets are concerned to complement what we can see, obviously, in terms of the ongoing tokenization of traditional markets? So with that, I'd like to close and pass back to Jeet.
Well, thank you very, very much, Keith, for that really engaging summary, to be honest, weaving through the absolute brilliant speakers that we've had today, which and thank you, Keith, for painting that picture and giving us an idea of what might still come. I really liked your last position there, which is, you know, the debate is still out there, still ongoing. I think one of the other speakers earlier on, you know, talked about where we are on this maturity cycle, and I think you've given us great food for thought there. So thank you, Keith, again for doing this. My utmost thanks to yourself and to all the great speakers that we've had today. Had some. I wanted to try to make sure we had a lot of variety today, giving people a lot of food for thought from many different angles, and it's just been humbling to see that from all the speakers today. And yes, it's been a busy week for financial services conferences here in London, but we were the only free conference, and I hope that with all the free post-pay videos as well, which I hope you all found insightful and continue to do so too. So with that last piece of housekeeping from me, the QR code hopefully will be appearing shortly on your screen. If it isn't already, please scan the QR code. It'll be your proof of attendance. And look forward to seeing many of you, all of you, even more of you tomorrow. Day 4 kicks off again at 1 p.m. UK time. It's our Tech and R&D Day. We're going to be doing some live demos of some funky new blockchain solutions that we have from our R&D team. I think many of you will find it really, really interesting. Thank you very much for sticking with us today. I genuinely hope you found this really interesting. Please feedback anything that we can work on better next year as well as we continue the series of Global Blockchain Summits. And thank you for listening, and thank you for watching, and have a good day wherever you are in the world. Goodbye.